just to recap, we were just covering some of the order flow concepts. We went for the depth of market, the dome, covered the basics of time and sales. Now, the time and sales is, of course, there's a number of different ways you could, set up the time and sales, but the basics of the way that I use it is it's very simple, just watching the orders as they go by. Now, the rest of the fancy work with the time and sales data is done in market dollar footprints. This is where we organize that data, and we can start to see patterns, which normally are not so easy to pick out unless you are glued to the dome and the time and sales. And I mean, when I mean glued, you can't miss a thing. You blink and it's gone. It's that kind of thing. I've often mentioned sometimes in the trading room where I said, okay, there's some spoofing there. Okay, it looks like those bids are all pulling out of the way, and I've had some of the guys saying, oh, I didn't see it. And, it was definitely there, but if you look away from it, you might not see it. So now I'm not sitting there watching the dome all the time. Stuff happens all the time, but you can, and there are traders that will trade just the dome really, really well. But they do have an area of interest, and generally they will trade either with the directional conviction, trade the momentum that's in place, or they will trade, some key support and resistance fading the directional moves. There's a number of ways to trade. The way that I trade, and exactly the way that I trade, is not the only way that you can trade. I'm sharing some of the stuff that I do, and how I approach it. This is, for me, my full methodology explained in one seminar to its fullest. But of course, I'm sharing the concepts, the foundation, the understanding that I have that allows me to do what I do, and that is pretty much what I'm putting across. Now, I will reiterate again, this is an art form. It's not a science. It's not a see this every single time and you buy it, see this every time and you sell. It all has to be put into the bigger picture. It all has to be put into context. And when you're looking at order flow, it's really important to trade it within context. Unless you are just looking for a few scalps here and there, which is fine. But even then, I think it's good to at least have an idea of where price is, and at least have an idea of what price is doing and how it is trading, whether it's trending, whether it's range bound, etc. So I think it's always a good idea to know whether the market is trending or whether it's range bound and trading sideways. Right, so we're looking at a 5-minute footprint here. So I just discussed the slide there, talking you through the basics of the footprints. Is anybody new to the market dollar footprints? Or not that familiar with them? Not necessarily just new to them, but not necessarily that familiar with them. Okay, not use them much, but know what they are. That's a good starting point. Okay, so if you go to Market Dollar's website, there's actually some good resources there. And I think it's a good idea if you do plan to use the Market Dollar footprints, which is, for me, it's an essential part of my trading. It really does help me out. If you go to the Market Dollar website and you hit the support area, then go down to education. There's a document here that's very, very useful. Now, this document wasn't there when I was trading, learning how to use the footprints and apply them. So Market Dollar has put a lot together since I first started trading with the footprints, and there's some great stuff here. And a lot of what I do and what I use from the Market Dollar footprints is pretty much explained in this document here. Learning to read the footprint. Learning to read the footprint right here. And this document is pretty much everything you need to know to build a very good foundation for reading the footprints and then going away and being able to apply those concepts. And most of what I'm going to discuss now is discussed in that document. So I feel it's a great read, and I wish it was around when I first started reading the footprints and learning how to use them. Now I'm pretty much self-taught with what I've learned on the footprints. I've watched them day in, day out, looking at what's happening, taking trades, figuring out what works and what doesn't work. You know, being through the phases of just selling every time I saw sellers hitting the bids and buying every time I saw buyers lifting the offers. And I've been through the phases of knowing learning when to take the trades and when to leave them alone. Learning through real experience and real trading, learning what works good and what works well and what doesn't work so well. And I think I've got a lot to share in terms of experience of using the footprints, and I don't think many places will go into the level of detail that I do. And Market Dollar themselves will recommend us to teach you how to use the footprints because we've been using it for a long time. Well, I say we, myself and the people that follow the work. Now, there are some other things here, market profile overview, etc. But because I'm specifically talking about the footprints, you might want to have a look at that. Now, footprint overlays is actually an idea that I initially came up with, but and started to share in the room because I was looking at two footprints at the same time, displayed in different ways, and then I found a way to overlay the footprints, and this actually shows you how to do that. Now, I'm not saying that I invented the overlays. I didn't. I'm sure other people also have used overlays in that way, and also
footprint overlays, which are essentially two or more.
Also found their own ways of using the footprints. But I did develop a way, and I shared a way to look at the footprints, which is quite unique. And some people like it. It's not absolutely essential to have it set up that way, but it does add a different dimension to reading this information, so I'll share that as well. So worthwhile checking these resources out. Definitely read this when you get some time, learning to read the footprint chart. I've dropped the link, direct link there in the chat panel. Okay, now it's nothing overly complicated, and most of you guys have probably watched some of the webinars that I've done on the footprints before. Like I said, each one of these bars can be set to whatever you like. Now, this is a 5-minute bar, and I'm sure most of you guys are familiar with minute-based bars, so I'm going to stick with that. But I do want you to take note that you can put this on whatever periodicity you like. You can have a look at 3-minute bars, and I'm sure most of you guys know what the periodicity setting does for a chart. It changes when the bar opens and closes. That's not so important when you are reading what's actually happening at price. So when the bars open and close is not so important because most similar time frames within the similar kind of time frame window will show you the same kind of information. So for example, a 5-minute chart, it'll be quite similar to, say, what would be similar? Maybe a 500, probably a 1,000 tick chart, which we're looking at the amount of trades, or probably less than that, about 750 ticks. But you know, it's looking at the amount of trades per bar. So tick charts are basically looking at the amount of trades that take place per bar. And then you have volume-based charts, which can specify a new bar being formed every time a certain amount of contracts trade. So you can have like a 10,000 volume chart. So every time 10,000 contracts trade, you get a new bar. So you can change that to whatever you like. And some of you guys will probably find one setting that suits you best. There is no real one setting. I, over the years, have used the combination of delta bars, volume bars, tick bars, you know, as you do, going through, trying to figure out which one's best. And at the end of the day, what I found out is it really doesn't matter. I generally like to see time-based charts. Oh, I think I might have just put this on 5 volume, which is probably going to take some time. I like time-based charts, and I like range-based charts, range bar charts for footprints, and I'll show you that. But let's focus on one periodicity to make this simple. This might just take a moment. There we are. It's changed to a 5 volume chart. As you can see, it will take quite a long time to work that out. Okay, so 5-minute bars. Everyone's familiar with 5-minute bars. Opens and closes when 5 minutes trade. Okay. Now, the way the footprints are put together, in the basic footprint chart, it will look a bit like this. A bid-ask footprint. This is probably the best way to learn it, because you will be looking at the volume as it's hitting the bid and as it's lifting the offer. So 2 columns, the left side, the bid column, the right side, the offer column, or the ask column. Offer and ask, same thing. You can change this, and you can display it as delta, which gives you one figure, which basically does a simple calculation. It takes the volume from the offer away from the volume on the bid, and you're left with one figure. It's either negative or positive. So if there's more volume that lifted the offer, it will be a positive number, and it is what we call a positive delta. If there's more volume that's hitting the bid, it will be a negative number, and it will be what we call a negative delta. Now, there's 2 kinds of delta. You can either have delta at bar, which I discussed yesterday, as you can see in this indicator here, right here, and you can see the delta plotted for each bar, each 5-minute period, as it is trading in real time, but also as it closes. You can have a look back and see how much delta traded down here. You can see how much delta traded in this bar, how much delta traded here. So it's a good way of organizing the time and sales data. You can keep a history of it, and of course it'll be very difficult to sort of build this up in your mind's eye, which is pretty much what traditionally tape readers are doing. They're trying to make sense of the time and sales data and trying to build this picture in their mind's eye, try to figure out what's going to happen. The market data footprint basically is a tool that allows for you to do that with the use of a piece of software. Now, I prefer to use the bid-ask volume. Now, the reason I like bid-ask volume is because I can actually compare how much volume is on the bid and how much volume is in the offer. Although you can just trade with the delta, which is a net buying and selling at each price, I have personally found it not as effective, and it's not as insightful as looking at both. So, for example, we could have a very high positive delta here at one of these bars, but I won't know how much volume actually traded on the bid, and that's quite important information to me. So even though we might have at the end of it actually had more buyers lift the offer at that price, which gave us a positive delta, I still want to know how much volume was interested in actually hitting the bid, because if it was a lot, there's still quite a lot of selling there. So the delta takes one thing away for you. It doesn't allow for you to actually see how much volume specifically traded at the bid and the offer. You're only left with one value. Now, if you look at the bid and ask, you can actually see exactly how much volume traded on the bid and exactly how much volume traded on the offer. Now, remember, this is the actual traded volume. So the volume that's trading into the bid is a combination of 2 things. It's the buyer's bids getting filled, but it's also the sellers hitting into the bids to allow for those buyer's bids to get filled. So it is a zero-sum game, remember. And then we have the buyers lifting the offers, which is also the offers getting filled for the sellers that are putting the offers in and putting limit orders in. But remember what I spoke about earlier. We're more interested in behavior. We are more interested in directional conviction and the imbalances we see in the order flow. And the way we can see that is with the sequence of trading as and when it's taking place. So now when we look at a footprint like this, we can't actually see exactly what happened in each bar, because as far as we are aware, we can only see that this bar opened here, closed here, opened here, then closed here. Remember that we've actually got the candle bodies there. You can highlight those in market data by just showing the open close box, and you can change the colors if you like. So that little dark red bar on the left hand side shows up when that bar opened higher and closed lower. A dark green bar shows up on the left hand side there when we have a bar that opened lower and closed higher. So we can see still the candlestick shape, and we can still see the open and the close of the bars. So that's not been lost. And actually, if you zoom this out, it actually turns into a candlestick chart. If you really keep zooming it out, see, it turns into a candlestick chart. And now I have coached some traders, and some traders actually prefer to look at it in this way. They actually have it set up like this, and then when they see the rejection occurring at a certain area, like I spoke about earlier, like this, then they will actually zoom in on the same chart and just have a look at what's going on after that, which is a good way to approach it, actually. So you only zoom in when you need to and have a look what's going on inside the bars when you need to. So that's a good way. You can zoom out and it automatically turns into a candlestick chart. Okay? Then you can zoom back in again and you can actually see how much volume is trading at each price and how much volume is actually lifting the offers and hitting the bids. So, you know, here we had a bit of a spike down, and you can see that from this bar opening here and then closing here. So this is basically a candlestick wick here. So you can see that even from this footprint. So if we was going to apply the price rejection concept that I spoke about earlier, we can say to ourselves, this is an area of rejection from looking at just that wick. Can everybody see that candlestick wick? I'll just highlight the real body of that bar. It's up here. So you guys can see the wick here. Now what happens after that? I've just picked out the most recent example here, but you guys can see what started to happen as we started to test that area. Only 40 hit into the bid. That's confirmation of rejection. Only 59 hit the bid. Only 1 hit the bid. And then only 7 hit the bid here. So we can already see that every time we're getting into this area, what's happening? Anybody want to tell me what that's a sign of in terms of order flow? So we anticipate more rejection might occur if we trade into that wick. But how can we actually see that and have proof of that? Well, we can see when sellers are struggling to hit the bids with decent volume and actually cause the market a downtick. So what is this a sign of there, guys? What is that a sign of? When we're going into this wick, what is happening here? Sellers are getting cut off, right? Which is a sign of what? Rejection of lower prices. So in the first instance, if you're looking to get long there, you can actually play more aggressively buying into this selling getting cut off. So sometimes I will get into trades and I will get the it would normally be somebody that's been learning the footprints or read about the footprints and, you know, understood the concept, the basic concept of more buyers lifting the offer, the market moves up, more sellers hitting the bid, the market moves down. But, you know, you then have to understand the other side of this, okay? If sellers are actually getting cut off, that's actually an opportunity to buy. Is there anybody that doesn't understand if sellers are getting cut off, that might be an opportunity to buy? That's the first sign of rejection of low prices. That's the first bit of information from the order flow that is telling you the market may stop moving lower. So that's exactly when you want to be looking to start getting in or looking to get in long, right? Now that's an aggressive entry, but I will play into rejection of lower prices if I can see the sellers getting cut off, and I will buy into that, and that's usually the best place to get in. And a lot of the time, you know, you don't take a lot of heat if you're right in that assumption. So it is only an assumption. It's an assumption that, okay, the market's proving to me that we're rejecting in that area. We're getting cut off, so, you know, I'll take the risk. We're getting long right now. So, you know, yes, there will be some cases we will still continue to move in that direction, but more often than not, you will see when the prices are continuously getting cut off around the same area, and we got 5-minute bar here cut off down there. Okay, a lot of rejection down there. Okay, we didn't see a lot of volume at the lows there. Okay, we see low volume here, low volume here. So we keep testing it. You might even wait for this bar before you pull the trigger. You might even wait for this bar. You might even say to yourself, okay, I don't want to get in just because sellers are getting cut off. I actually want some confirmation that buyers are lifting the offer. And here's an example where that then starts to take place. The sellers have got cut off, and then you see what? Buyers start lifting the offer. 946 lift. 919 lift. 2,631 lift. So that's your confirmation. So you can wait for that as a heads up. That's the rejection, but you wait for it to uptick, and then buyers start lifting the offer, and it starts to prove that that low is actually being put in, and then you can start to get long right here, as and when you see it happening, right in the moment. Now you don't wait for bars to close. The whole idea behind trading order flow, you're trading inside the bars. You're trading what's actually happening inside the bar. I mean, you can get a profitable trade just from trading the low of a 5-minute bar into the close of the 5-minute bar. You can close the open of a 5-minute bar into the close of that 5-minute bar, you know, on the downside. So that's the first thing you'll look out for. So if you're looking for a long, you say to yourself, are the sellers getting cut off? But you know, you have to have an area to stalk and look for that information. The way you can see that on the footprints is with these low volume prints. Now, every market is different. Every market is different, and every market trades a different amount of volume. Now, if you trade a more volatile market, like say the Nasdaq or the DAX or something, anybody want to give me a market, maybe more of a volatile market that we can look at? Choose a stock index because I've got them open. I said choose a stock index, and then we have someone say crude. Right, I can open up crude. All right, so okay, Peter David, NQ, you got it. Okay, NQ. So let's have an NQ. Let's have a look at NQ. There we are. Right, so here's the NQ. You know, a bit more volatile. Maybe let's bring up an NQ chart that we can have a look at. What's going on in some areas. Now, I will state one thing, that the more volatile markets generally are a bit tougher to read rejection on, and you probably want to be a little bit more careful trying to pick tops and bottoms on the more volatile markets. Now, when I traded the DAX, most of you guys know I traded the DAX for quite some time, and you know, it is and still is one of my favorite markets, but I just don't trade it now. It's a lot more volatile than the ES. So generally, I do approach more liquid, less volatile markets a little bit more aggressively, because I usually trade smaller ranges and tighter ranges, and generally don't fluctuate so much once you get in. Now, with the more volatile markets like the Nasdaq and the DAX, the idea is to watch for the rejection, but you probably want to wait for some confirmation before you actually get in. Okay. These are 5-minute bars. There's quite a lot of 5-minute bars trading here. We might want to have a look at something like a 10-minute. So, you know, let's just go back to, where do we get some pretty good? Yeah, these lows started to hold quite well here. So have a look at these lows here. So this is the area that we're interested in. And notice what happened at these lows. So, you know, firstly you start to see lower volume hitting the bids. And then you can see the positive delta start to build in this bar. And we closed higher. Now, we did actually revisit this area. But you can see as we revisited the area where there was the lows of this 10-minute bar, where we can see there was some wicks here, okay, because that's where the real bodies end. You can see this market comes back and tests this area and then rejects, and that's a good sign when you're looking to reject those wicks with order flow. Good confirmation that we're starting to push away. Now, the thing is, when you're looking at footprints after the fact, you can't actually see what actually happens afterwards. So the best thing to do is use market delta replay, and you can replay the footprints. And you can have a look at how they build in real time, tick by tick. So, but the concept is the same. You know, lower volume trading, you'll see it a little bit more so, and it'll actually end up sort of trading through, because these are quite low volume markets anyway, on something like the NQ. But something like the NQ, what I like to use, and something like the DAX, what I like to use is a slightly different kind of footprint profile. And this is where I like to use the overlays. I'll show you that now. I like to use something like this. It's the same concept, you're still looking at bid and offer information, but because they move so fast, these markets, it's a little bit difficult to keep up with the volume at price information because it moves so fast. So I find it personally nice to watch this style of footprint, which is a little bit more visual. Now, what is this? This is the same thing. It's the bidder ask information. But if you click on a footprint profile, you have the option here to display it as delta, as I showed you earlier, bid ask. There's also an option to display it as a footprint profile. Now the footprint profile does show you whether there was more aggressive selling or more aggressive buying, but only through colors. It doesn't actually give you the numbers. But what it does do is actually gives you a volume profile. So now we were talking about the volume profile stuff yesterday. If you understand volume profile, low volume areas of rejection and high volume areas of acceptance, this is where this comes in handy when you're trading more volatile markets, because you want to be a little bit more conservative with them. So what you would do on a more volatile market, like this market was topping up here, and what we commonly see is these P formations. There's a lot of volume trades at the highs, and then we get cut off just above it. Now in previous seminars I covered this in quite some detail, and what we'll also see is profiles that are balanced like this, which actually means this market really is just accepting in the middle of this range. So this is where the volume profiling stuff comes in handy, but on a more micro perspective. So if you understand high volume areas as an area of acceptance and low volume areas as an area of rejection, you can apply that from footprint profiles as well, from a footprint profile perspective. Okay, so what you can see here is, okay, we're up here, we're in this area, but rather than try to figure out where this market, because it's quite volatile, may reject, what we may do is look at rejection as a heads up only, because it is more difficult to pick tops and bottoms in more volatile markets. So you use that as a heads up only, and then use something like the Heikin Ashi bar for an entry, or use sellers hitting the bids and actually picking up some momentum moving lower. And if you're even more conservative, you can actually wait for the next bar to trade lower and close with some acceptance lower. Okay, so if you'll notice on each one of these profiles, I'll actually have a yellow box. This yellow box is basically the highest volume node. It's basically like the VPOC. So in a way, what we're looking at here is VPOC shifts. It's the volume point of control shifting higher and lower. So if you're trading a more faster market that's less liquid, and generally it's the less liquid markets that are more faster and they move more rapidly, generally you don't want to be too aggressive. So the general guideline here is when you're using the order flow, be more conservative with your entries on the faster, more volatile market, and be a little bit more aggressive with your entries with the more liquid markets. Okay, so it's important to take note here that you don't approach every market in exactly the same way. Okay, the concepts in terms of auction market theory principles are the same. You know, the bigger picture is the same. We look at the same setups. But when it comes to execution and timing on a trade on a faster market, something like the DAX, the Nasdaq, crude oil, it's not as easy to time aggressively. Okay, and now that's my personal experience. Okay, so you might, in these situations, on these faster markets, prefer to look for more what I call initiative activity. But you will still observe that the market's getting cut off. You will still observe that buying is drying up. You will still observe that there's low volume trading at the highs. And you will still observe, you know, these topping P formations. You will observe in bottoming B formations. Now those are more easily seen on the more volatile markets. And you'll see them all the time. And here's the top information. You know, we do come back and test it, and we reject there just at higher prices. But in these cases, you want to wait for that market to start selling off, okay, and hitting the bids. And because these are more volatile markets, it doesn't matter if you get in, you know, 5-10 ticks lower, because generally these markets have much wider ranges. Therefore, the profit potential in ticks is usually greater. So although the risk might be more and the market moves around in wider ranges, where you're looking for your entry, the risk is, you know, usually in line with the kind of potential reward. So, you know, there's a Nasdaq there, but one of the things that you do want to make sure you look for when you're trading more volatile markets is follow through. Okay, I often talk about order flow being approached in 3 steps. Okay, step 1, heads up, which is get interested. You know, move to your trading platform getting ready to pull the trigger. But heads up doesn't mean you're going to get in. It just means get focused, get engaged, get ready to get in. Now, I could have heads up, heads up, heads up all day long and never end up taking a trade. Because a heads up is just that. It's a heads up. Get your head up, get focused, get ready, because you might have to take a trade now. And you need to know that ahead of time. Okay, because once the order flow comes in, it can happen so quickly, especially on these fast markets. You have to already have your physical hand on your mouse ready to pull the trigger to get in. You know, you haven't got time to mess around when you're trading order flow. You've got to be pretty quick, especially on the fast markets. So heads up is the first step. Then step 2 is confirmation. Confirmation can come in a number of ways. So heads up could be, let's use this example that we just see this top information here on the NASDAQ, and we move to the ES as well. Same concept. So heads up could be, you know, low volume trading up here, possible balance, indecision. And then confirmation could be that the sellers start hitting the bids here more aggressively and the delta starts to get negative. And then the follow through is the continuation of sellers aggressively hitting the bids at lower prices. And that will be your reason to get in. So step 3 is then the confirmation, the follow through. So you got heads up, confirmation, follow through. So first step, heads up. Second step, confirmation. Third step, follow through. Okay. Now on a more liquid market, it does happen in the same way, but it happens within a smaller price range. So, for example, on the E-mini S&P, you'll see something like, you know, like this. Heads up, only 7 hit the bid. Okay, in an area of rejection. Confirmation, buyers start lifting the 64 quarter. Okay, 946 lift the offer, only 286 hit the bid. Further confirmation and follow through, 919 lift the offer. And follow through again, 2,631 lift the offer. So there's your confirmation. Okay, so you got confirmation and follow through. So again, you know, if you're looking at buying down here, we come in, test this low volume area again, test this rejection area, we get into this area. These sellers all of a sudden get absorbed. They can't push the price lower below that 63. Then what happens? The market lifts up, tests 63 quarter, only 285 hit the bid, and then we start lifting 63 half. And this is where you take interest around 63 quarter, and then around 63 half, 63.75, that's where you have to get in. Now, there will be some cases the market moves so quickly, you have a plan to get in somewhere like, say, this area. But the market just moves so quickly, you don't get a chance to get in. Now, if the market does that, I normally just wait for the next opportunity. It does depend on the potential opportunity in that trade. Now, if I'm buying up here and I can still see there's still some decent potential in this trade, even if I'm getting in later, that's fair enough. I'll still go for it there. But if I see I'm gonna buy into some immediate resistance, so you know, if I look to the left, for example, if I look at this immediate resistance here, where the market delta footprints were actually topping out, and of course that's just price is topping out there. If I'm about to lift the offer here, ideally I want to lift it here. Now, if I end up missing that and find myself looking at a trade here, that's now buying into the unfair high. So if we perceive this as an area of value or balance occurring, as we said earlier, trade location is important. So let's come back to that concept. You know, you've got to see this as fair price in the middle, unfair high, unfair low down here. So ideally we want to focus on getting long in this area. So trade location is important, and you do have to use these order flow concepts in reference to that. So if I'm in a situation where buyers are lifting the offers and I've just missed my entry at these unfair lows, and we just hit some resistance, I normally wait for that resistance to get broken. Okay, I don't like to play breakouts personally. Okay, now breakouts do play off, and you can often see them getting ready to set up to play off, but I normally don't go with the breakouts because they are usually short-lived. I normally like to focus on fading a breakout, so I'm very careful in buying a breakout of a high or selling a breakout of a low, because it goes almost against my concept for trading and the way that I trade, because I'm looking to pick out unfair lows for buying and unfair highs for selling. So if I end up buying at unfair highs or selling at unfair lows, I'm sort of going outside of my model for trading. So remember, The auction market theory principles and understanding the market structure is a framework for thinking and doing business. So, these are some of the simple concepts, and this is pretty much what you have to apply. Don't get hooked up on the specifics of the order flow. What you're more interested in is how much volume is lifting the offer when you compare it to the volume hitting the bid. Is it more and is it greater? And if so, how much greater? Now, there are some guidelines, okay? Now, on the E-mini S&P, we generally see 2 to 3 times the volume lifting the offer when you compare it to the volume hitting the bid. And that's usually a good sign that, you know, the aggressive buyers are really coming in. So, you know, let's see if there's any examples here. You know, something like this. 2689, it's almost 2 to 3 times more than what we saw hit the bid, 1106. You know, here 2458 lift the offer. Again, it's nearly 2 to 3, it's more than twice what hit on the bid. Now, that's not exact, but you know, you get the idea. You know, 2983, you know, that's 3 times more than what we saw actually hit on the bid there. So you can compare the volume lifting the offer as compared to the bid. Now, most of the time you will see some volume hitting the bid as well as lifting the offer at the same price. Hope that makes sense. So there is no specifics in terms of the amount of volume that has to lift for the market to move higher, amount of volume that has to hit the bid to move lower. You will find some patterns. Now on the S&P, I often see 1,500 or so, 2,000 or so lift the offer, and only less than 500 or so hit the bid, and the market, you know, generally moves off that. But you know, it's not all of the time. It's something that does show up quite often. But the thing is, the volume goes up and down. The amount of volume that actually trades daily goes up and down. You know, if you're trading ahead of the cash market open, there were still setups on the footprints, but they were generally trading off a lot lower volume. But you know, the imbalances do still show up between the amount of buying that's lifting the offer and the amount of selling that's hitting the bid. So the imbalances is what you're looking for. So you want to see, like I said, an imbalance of order flow lifting the offer versus the volume that's hitting the bid. You want to see an imbalance of order flow hitting the bid versus the volume that's lifting the offer. Hope that makes sense. Now we can look at some more examples. Let's have a look at the Euro stocks. Some of you guys asked to look at the Euro stocks there. And feel free to jump in and ask questions about the footprints at any point in time. Now, here's the footprint profiles with the overlay. So you've got a footprint profile in the background, but you've got the bid-ask information overlaid on top. So these are basically 2 footprints overlaid on top of each other. Now, probably better to go back into the earlier part of the day on the Euro stocks when there was more volume trading. Now, this is a good example where we see lots of selling hitting the bid, but we're not able to crack that bid. That's a sign that there are actually some real bids absorbing that selling. Okay, and that's normally why we can't crack that bid. What I mean by crack the bid is we crack it, we go to the next down tick. So 2504, we couldn't take it out. So it's 2505 in this situation. 2505, we couldn't take it out. We couldn't even go to the 2504. So what you see here is that ended up holding, and then it put in what I call the B formation. So this is when a lot of volume trades into the low of the bar, but it still doesn't move lower. So something's got to be happening there. If a lot of volume is trading into those prices at that lower area of that profile, the lower part of that bar, and we can't push lower, that's often a sign of absorption. Okay, absorption taking place. That means the buyer's bids are absorbing the sellers that are hitting the bids. And then what you commonly will see is the lift follow through after that. You'll see the volume start to lift the offers, and then we see the follow through. You'll also see it on the other side. I mean, here we see buyers lifting the offer, 605 lift the offer. Not quite a P formation. Let me find a P formation. It's quite commonly there. Actually, you saw it here in the next bar, but this is where we see the P and B formations quite commonly. Maybe you saw it here, actually. Look, lots of volume lifting the offer. Now, we did uptick. We only saw 5 lift the offer above it. But you know, you can see a lot of volume concentration at the high of the bar here, and we couldn't get through that offer at 2523. Okay, we couldn't get through it. So next thing to look out for is, okay, you'll usually see this market testing that, trading, and it just can't uptick. It can't uptick, and that itself is a sign that it's topping, possibly it's topping. So the next thing, that would be your heads up, and then you say to yourself, okay, if the sellers can even start hitting the bids now, as long as the buying doesn't start picking up again and start lifting the offers, I'll look to get short. And you'll have to know that ahead of time. So you'll see this and you'll be sitting there ready to get short, you know, way before you actually pull the trigger. So this is, you know, always look for the buying getting cut off, the sellers getting cut off as a heads up, getting you ready to take the trade. But it doesn't necessarily mean you will get in. Now, when this initiates, you can see the market generally starts to drop. As more sellers start to hit the bids here, drops off. As more sellers start to hit the bids here, we get the follow through, it drops off. So, you know, you can see that on the market data footprints. Now, I shade each price so that it's visible visually when there's more selling hitting the bid, and as well as when buyers lifting the offer. Now, you can actually change the threshold levels so that you can see the kind of delta that you are looking for, the delta being the net buying and selling at each bar, and you can define, you know, the shading. Now, market data will automatically shade these bars, but I have shaded them manually pretty much for every market that I trade. There are some guidelines on Market Data's website for delta values for manual shading, which is pretty much spot on, but you know, sometimes it does have to shift up and down. But generally, you know, this is it for the Euro stocks. If anybody's not quite sure what I am using, I prefer, you know, you guys just understand the concepts and apply it yourself and put your own settings in there. But if you're not quite sure how to start out and you're not quite sure for a specific market, just ask me and I'll be sure to let you know what I use. That is if I'm following that market. And we've got some threshold levels, level 1, 2, and 3. So basically level 1 will be a lighter shade of green or red. Level 2 will be a sort of a medium shade of green and red. And then level 3 will be a very bright green or red shading. Now you can actually change the color. So it doesn't have to be green, but I color code my chart. So green often signifies buying and red often signifies selling. Now you can see my time and sales are set up that way. My delta bars down here are set up that way. That's the volume breakdown indicator, by the way, that I covered yesterday. And you can change the colors to whatever you like. Okay, I like red and green, but some of you will not like those colors, and you know, you can feel free to change the colors. Now, the reason I like to do that is shade the delta thresholds is because it's just easy for me to see when there's a lot of aggressive selling and a lot of aggressive buying just by looking at the colors. I mean, I can see that the buyer's got a bit aggressive here just from looking at the bright green. I can see where the seller's got a bit aggressive here when we see that bright red, and it kept following through. Right? You know, a bit of selling here is more aggressive, and then you can see it gets lighter shades of red, and that's a first sign right in this area that the sellers are actually getting cut off. So when, you know, the market's moving up and you start seeing light green shades, that means the market may be getting cut off on the buy side. When you start seeing the market selling off, pushing lower, and you start seeing those light red shades, that means the market is likely to get cut off. And you see it time and time again. Like here, you know, this market was pushing lower, sellers are hitting the bids, but the volume starts to dry up hitting the bids. And you can see that visually on the footprint. Okay? Let's move back to the ES. Again, you know, doesn't matter what time frame or periodicity you look for that information, you can see it everywhere. And it doesn't matter what market. You know, have a look at the ES here. You can see the volume did dry up here in this area. A bit on the sell side. Okay. But, you know, it picked up again here. And, you know, into the end of the day, the buying started to dry up here as well, which was a bit of a heads up. This selling was going to come in, and you can see into the close of the day, the selling came in. Right. Any questions about that stuff, guys? Any questions about the footprints? I'm just going to grab myself a quick glass of water. Right, okay guys, so no questions about the footprints? Okay, yeah, I was going to move on to that afterwards, but I can cover that now if we don't have any questions about the footprints specifically, because the footprints said it's just reading the information, but if you understand the basic concepts of what I've just discussed, you can apply that in many different ways. And this is the way that I want to teach this and put this across in a way that you guys can understand more of the basics, and which provides a foundation for you to become creative with that level of understanding. So, but this is stuff that not everybody knows, right? It's took me a long time to learn everything that I know about using these tools, but this is the most effective tools that I use, and this is how I read them, and this is how I see this information presenting itself. But each and every day that I trade, I read this information and apply it in the moment. I try to figure out what's going on right there and then, rather than say every time you see this buy, every time you see this sell. I'm not doing that, because you can't break down trading into that kind of model. It's more so about reading behavior and trading what you believe the market participants are doing. At the end of the day, that's what we trade. We trade our beliefs about the market. But we should use tools so we can formulate beliefs about the market that make sense, and allow for us to speculate on future price movement, effectively. So, I mean, can you guys see how you might put this to use? Within the context of everything else I've already discussed, of course. Not just by itself. You might use it by itself, but especially if you are coming from the perspective of understanding market structure, understanding where the good opportunities are, understanding price rejection, and then understanding order flow. Can you guys start to see how it will fit together to get into a trade? Find the opportunity and then find yourself a reason to get in, right? Good stuff. And that's really all you need to trade. As long as you're not looking for certainty, you're okay. As long as you just want to get an edge, and the thing is, I feel that personally there's nothing better for building belief and confidence in what you are doing as a trader than actually understanding what's going on. If you really understand what's going on and you can read the information, market generated information, so it's not information we're just making up, it's factual information. The great thing about the futures markets, the great thing about the futures markets is that they are transparent. We can actually see exactly how much buying and selling is trading at every single price. It's fully transparent. Now, yes, there is manipulation, but even that manipulation, we can figure it out, we can see it, and in some cases it helps us out, making some decisions, because we can spot it. So, but at the end of the day, the market has to move of supply and demand. And if we can actually read the level of supply and demand, and we can read how aggressive that supply and demand is at any given time, we definitely do have an edge. In terms of an information edge. Okay, right, good stuff. Now, yeah, I mean, the basic concepts, just to reiterate here, that the basic concept is low volume, hitting the bids as a possible sign of selling getting cut off, low volume lifting the offers as a possible sign the buying's getting cut off. And of course, that will sometimes print as low volume into the high of the bar, but will get taken out, and that's what you have to watch for. I will say it in the trading room. If anybody doesn't know how to apply this in a real-time environment, you have to get into the trading room. Most of you are, but if you're not, then it's good, even if you just join for a month or so, to have a look, because I think it's worthwhile just to see how it's applied in real time. Because the thing is, here, this is a weekend seminar. We can't look at the market live, and we can go back and do market data replay. But it's not exactly, like reading a real market. Okay. So, these are the concepts, but you do have to learn to read it in real time. Remember, this is going to be building in real time at each bar. Okay, and you've got to anticipate what's going to happen next before it happens. But as long as you can stay on top of the information, as and when it's presenting itself, and you can understand what is being said, and you can read what the market is telling you, then you're putting the odds in your favor. Remember, you don't have to be right 100% of the time. I would get into trades and it looks good, and then all of a sudden, the order flow looks completely different whilst I'm still in that trade. And it looks like I could be selling into when the sellers start to hit the bids, and all of a sudden more buyers lift the offer, and it doesn't look as good as it did when I first got into the trade. Now, the best thing to do in that situation is to just get out. You can always get back in again if it looks good. Okay, so what you have to remember is when you're reading real-time information and you're getting into the trades in the bar as it's trading, there might be some times where you get in, it looks good, and all of a sudden what you were reading and the reason you got into the trade changes. But that's the premise of the trade changing. The premise and the reason for getting into the trade is no longer present. So then all you do is just get out. There's nothing wrong with getting out of a trade and scratching it. I do it all the time. If I don't like what I see anymore, I get out. That's basically what I use to get out of the market. I use market generated information to get out of the market. I don't get out of the market because price moves against me, because price itself a lot of the time will move against me, but price itself is just the advertising mechanism. Going back to yesterday, it itself doesn't mean anything. Price moving against me doesn't change the structure itself. It's only when the volume starts to trade there and order flow starts to trade there to confirm that price may be continuing to push in that direction. That's when I'm a little bit wary and I start getting out of trades. Now it's going to come in on to the next topic of trade management and stuff, and then we'll start going into that in a little bit more detail. Right. Now, I've often said that trade execution is about developing a feel for the market. Not even just trade execution, but also, identifying the opportunities, and especially when you're managing the trades. You definitely have to develop a feel for the market. Now, the downside to that is that nobody can give you a feeling for the market. I can't give that to you. Nobody can give you intuition, because this is very much a personal thing. But I have to share this because intuition is an important part of my trading, and developing a feel and feeling what the market is doing is an important part of my trading. So it's important for me to discuss it, because I don't just trade off what I see, I do also trade off what I feel. And you talk to any decent trader out there, they will all say the same. I have yet to meet a trader that doesn't have a feel for the market, a trader that is profitable, that doesn't have a feel for the market. You have to have a feel for the market. Now, I can't give that to you, but I can give you the guidelines to develop that feel. So this is what it's all about, getting in tune. First of all, easiest thing you can do is just focus on one market. Okay, aim to master that market. Don't trade anything else until you have mastered that one market. I know some of you will want to trade others. Some of you may have to trade other markets because it's your job if you are a professional. If you're trading for funds or whatever it might be, there may be a requirement for you as part of your job specification to trade other markets. That's a different story. But for those of you that can choose what markets you can trade, okay, you do really want to focus on one market. But for those of you that do have to trade multiple markets as a part of your job specification, what you are required to do for the firm, then at least develop a niche. So if you trade stocks, get a feel for a certain sector and focus more so on one sector. If you trade currencies, get a feel for a few currencies pairs that that you can really focus on rather than, looking at everything. If you trade commodities or agricultural products, whatever it might be, okay, just develop a niche at least anyway, okay. So, but for those of you that are learning how to trade and are new to this and have the choice to choose what you trade, do just choose one market to start off with and master that one market. At most, you might want to trade another market at a different time. So, for example, you may decide to trade the European session and trade a specific market. Then you may trade during the US session and trade a different market. Now, I do that, but I have a business plan that is set up to trade 3 different markets in the European session, but I would only trade one market at a time. So the 3 markets in my plan is the DAX, the Euro Stocks, and the Bund. But the reason I have 3 markets is because there are times where I have to adapt and trade one of the others. There might be times where that specific market that I would normally focus on isn't giving me the opportunities that I'm looking for, and the other market looks better. So, I do that, but even during the US session, I focus on the E-mini S&P, but there's been a couple of days this year where I've ended up trading the NASDAQ, but my major focus is the E-mini S&P. But the only reason I will adapt and trade something else is if I feel that there's better opportunities on that particular day and a better range on that particular day. So, yes, feel free to adapt at times, but I still think at first, for most of you, it's best to develop a feel for one market and just choose one market. And the days it's not really trading that great, just learn to sit out and don't trade it. So focus on one market. That's the best way to firstly develop a feel for the market. Get a feel for the rhythm of the market. That's the only way you can really develop a feel for a rhythm of the market, if you focus on one and develop a relationship with the market. Develop a relationship, get to know the market. Know how it feels when it's topping, know how it feels when it's bottoming. Every market has a feel. The way the ES feels when it's topping feels different to the NASDAQ when it's topping. The way the DAX feels when it's topping to the Euro Stocks is different. Okay, there's a similarity in terms of the stuff we will see, but the feel is a little bit different because the momentum, the flow of that market is different. Okay, every market has a flow, it has a momentum, and you have to develop a feel for that market and that momentum and the way it flows. Know how it feels when it's ready to turn. So you might get a feel for when it's topping, bottoming, getting cut off, but you might also have to develop a feel for when it's getting ready to turn. How does it feel when it gets ready to turn? How does it feel when it's actually starting to move and it's picking up some momentum and it starts to move directionally? What does it feel like? These are the questions that you all have to ask yourselves. Okay? What are the harmonics of the market? What are the natural rotations of that market? What kind of moves do you normally see? For example, the E-mini S&P spends most of its time making swings of between 1.5 points to 3 points. Okay? Every now and again, we'll get 5 to 6 point moves, and sometimes a 7 to 10 point move, and very rarely, more than that. So, my objectives are set for each market based upon the harmonics of that market. Okay, so you need to know that particular market that you trade, how far does it normally go when a trade plays off? Because there's no point looking for 100 ticks in a market that normally only gives you 30 ticks. It's like, me always going for 20 points on the S&P, where I know the natural harmonics of that market is 3 to 4 point rotations, and every now and again, if I play in line with a longer time frame, I'll be able to get about a 7 to 10 point move without an adverse rotation against me. I know that because I know that market. I know on the DAX that you will commonly get 30, 40 tick moves against you when you are still in the trade and it's still trending. I know that on the Euro Stocks that most of the decent swings in that market are only about 10 ticks wide, and every now and again you get a 20, 30 tick swing. Right? So, you got to ask yourself, how many of you know your markets that well? One market. And if you have an answer for one market, that's the market you want to focus on. Which market do you know well enough? And if you don't know, I'm going to show you a way that you can just develop a feel for the rotations anyway, and do some studies on that. But you need to get a feel for a market. You need to know, okay, usually I get this much out of this market. Usually this market will swing for this long. it will give this much. It would usually go from here to here. Now you can get a feel for that from structure, market structure, but you know, a wide swing, if I've got a value high that is 30 points away on the E-mini S&P from the value low, it's a very rare situation. I mean, it generally just wouldn't happen for us to get a 30-point move down without a rotation back up. So, you know, what is most likely to happen? You probably have a 7-point move down and probably about 3 or 4 point bounce up. You know, so you need to know the harmonics of that market. What normally happens, not only when you're getting into the trade and looking for the entry, but also once you're in the trade, what is normal for that market to do? What kind of adverse excursion is normal? What kind of favorable excursion is what you expect on that particular market? Does everybody understand that? So, you know, get in tune. Focus on one market. Trade one market day in, day out. Don't make it complicated. I'm going to show you some things, you know, in terms of trade management to get in tune. But the best way to get a feel for the market is go through what I call the trade tuning process. Now, some of you guys, unless you've been in the trade room, probably never heard of this before, because it's something that I've made up personally myself, because I go through it all of the time. It's something that I felt was necessary for me to develop a feel for the market. So I call it the trade tuning process. I did it on crude oil, live in the trading room when I was developing a feel for crude oil, because I said, okay, gold, crude oil, got some great moves. I'm not really feeling what the S&P and the YM, the Dow is doing right now, or the other indexes. You know, let me move to crude oil and gold. So what I said in the room, this is back in 2010, I said, I'm going to trade this market, you know, a couple of contracts, and show you how I develop a feel for a market. You know, I'm going to trade one contract, then I'm going to trade two, and then, you know, you build it up over time. That's what I call the trade tuning process. Trade tuning process, you trade it small, and you get a feel for getting in and out, but not looking for too much. You know, you could trade something like the DAX, but only go for 10 ticks. You know that market could give you a lot more. But to get a feel for getting into that market and get a feel for the rhythm of that market, you don't have to trade it big. You do want to trade it because it's through the actual trading experience that you develop a feel for the market, because nobody else can give that to you. You have to develop it for yourself. So you do have to trade to develop a feel for the market. Now, some of you can do that in simulation to start off with, but I do urge traders to not spend too much time in simulation. Simulation is great, and I do take traders on a mentorship program through that phase, but that's only to build belief and confidence to take them to the point where they can be live and actually have some confidence in what they are doing. Now, if you don't have any belief and confidence in the way that you trade, then it's a good idea to trade in simulation, firstly, to develop that belief and confidence. But you can also, if you have more capital available and you're willing to, you know, risk some capital to develop that feel and get in tune with the market, then risk some capital, but just trade it small. Just trade up to a couple of contracts, or even just one contract. That's sufficient enough to get in and out of a market and develop a feel. Now, you're not looking for big moves, you're not looking for big runs, you're not necessarily even looking to become profitable when you're trade tuning. You are just looking to develop a feel for the market. But at the same time, because you are in that phase of developing a feel for the market, you don't want to put too much at risk, because you still don't know that market that well. Does that make sense, guys? So, you know, anytime I stop trading a market for some period of time, I will go through this process. Every time I want to trade a market that I've never traded before, I've been trading for over 11 years now. It doesn't mean I know how to trade every other market out there. For example, I've got very little experience in trading the agricultural products. Okay, I might know how to find the setups and the opportunities and identify the setups, but a setup is just a setup. The actual trading part is getting in and out of the market with a profit, and that requires a feel for the market, as well as an understanding of structure, right? So I don't personally like the idea of moving to markets and just trading them just because I feel I can trade other markets. I feel that it's necessary to develop a feel for a market, even if it's just for 1 month, even if it's just for 2 weeks. Now, I went through this on crude oil. I've done 2 to 3 weeks through the trade tuning process on a couple of one contract. Then I said, okay, I'll put a couple on, etc. I did this again on the E-mini S&P. Some of you guys are probably not familiar with my process in my trading career, but you know, I started off trading just the Dow, and I traded the Dow solely, nothing else. Then I started to trade the Dow alongside the Russell and the E-mini S&P and the Nasdaq. But I really only focused on trading the Dow. And then I started to focus a little bit more so on trading the DAX, which actually didn't go too well for me initially. But as I spent more and more time with it, I started to get better at trading the DAX. I developed a feel for it. So I was trying to trade the DAX in exactly the same way that I traded the Dow, and it didn't quite work. So I know it's essential because I know I was profitable in the Dow and I had to move to the DAX. And the DAX, I wasn't familiar with the market. It moved completely different. It had a different rhythm. It had a different feel. So, but I spent time mastering the DAX, and it became my main market, and it will, and it has been right up until last year in August. Okay, and you know, during that time, I've also traded the E-mini S&P, especially since around 2004, 2005. I focused quite a bit on the E-mini S&P, or specifically from 2005 onwards, during the US session. Okay, now I stopped trading the E-mini S&P when I started to focus a little bit on crude oil and gold, and then I focused primarily on trading the European sessions. And I didn't trade the E-mini S&P. I think it was probably, I can't remember exactly. I think it was about the end of December 2010. Okay, something like that. So I stopped trading the E-mini S&P, and I was trading it in the room all the time. And then I decided to put all of my focus and attention on trading the European session. So I stopped trading the E-mini S&P for a little while, but I still covered the E-mini S&P in the trading room. Now, last year I started trading it again in October, the E-mini S&P, but and I went through that process again. The E-mini S&P had changed its rhythm, its feel. It was different to what it was in 2010, especially since August and September. It was a lot more volatile. The depth was a lot thinner. The market was moving more swiftly, more quickly. So I decided to start trading it again. And last year, I started to pick up the E-mini S&P again, and I started to trade that in the room. And I started off trading up to 10 contracts, maximum position size. Okay, and I did that right until end of December. And most of my trades were between 2 to 4 contracts, up to around 8 contracts, and sometimes 10. There was the odd situation where I moved it up to around 12. Okay, and then my plan was, the whole idea was to get ready to trade the E-mini S&P bigger again and larger coming into 2012, which I did. And now, you know, I trade bigger position sizes, and mostly my position sizes are up to 40 contracts on the E-mini S&P. Now, it's not huge, but it's not, you know, not too small either. But on average, my trades will be 20 to 40 contracts. Sometimes I go in with half a position, sometimes quarter of a position, sometimes I scale in with tens. So it's not huge. And the Euro stocks, most of you guys know, I'd be trading up to 30 contracts, and I went up to 50 contracts at the beginning of this year. Then I started to trade the Bund, which is usually up to around 40 contracts as well, maximum position size. So I don't trade huge, I don't trade too small, somewhere in the middle, but it's okay for my risk tolerance. So for you guys not familiar how that I trade and what kind of sizes, that's what I trade. Okay, so, but I went for the reason I'm covering that is because I stopped trading the E-mini S&P, even though I traded it for so long. Because the rhythm and the feel of that market changed, I had to get it back in tune with it. So if you stop, even if you stop trading for quite a significant period of time in a specific market, you get back in tune with it. Just trade it a bit smaller. You get back into the feel for it. Okay, get back into the rhythm. Now, not everybody has to do this. I'm just telling you guys what I do. Okay, none of what I share with you guys has to be done. You don't even have to agree that this is the right thing to do. Some of you may feel that, okay, why do I need to do that? You know, I know how to trade. The market, you know, I can get a feel for it, no problem. So you probably won't need, you might not need to do that. But personally, for me, I can only share from my own experience and what I do. And what I do is this specific process of trade tuning and getting back into the market and building size again. Now, I started to trade the Euro stocks again in August. I started off with 8 contracts, but it was quite volatile then. And then I moved to 15 and 20 within a 2-week period. Then I moved it up to 30 contracts within the next month. Okay, so, you know, it doesn't have to take long. You can start again small on one market, even just for 1 week. It makes sense. If you haven't traded that market for a while and the rhythm and the feel has changed a little bit, it makes sense to trade it a bit smaller, take less risk. 1 week is not going to do a lot, even if it's 2 or 3 days. Just shorten the time you do it for, okay? But get in tune with the market and make sure you do master one market. You know, you can start trading more and more markets as you get more and more experience and you get better as you trade. Okay, so each and every single one of you will be in different situations, different phases in your trading career. Now, in Market Delta, there's something that you can use called a zigzag tool to get a feel for the rotations, the rhythm of that market, a feel for that market. Now, this is not going to give you feeling or intuition itself, but it's going to give you an idea of the rotations of that market and get a feel for what kind of moves you would usually expect on that market. So let's have a look on the E-mini S&P. Now I've got this button set up here, rotations, and I normally put this on and off as and when I need it. Okay. Now I probably want to just drop this to a 0.75 Renko chart. Now you're not going to get, you can get a rough feel from just eyeballing this. Okay, so I can put this on and it tells me exactly how big each swing is from the low to the high. Now that's useful because it's useful for getting a feel firstly for the kind of volatility in that market, but also useful for getting a feel for what kind of potential objective makes sense based upon the harmonics of the market. So this is called a zigzag tool in Market Delta, and you do get it in Investor RT as well. Now, you can take into consideration bigger rotations by changing the minimum price range. I can change that to 20 bars, but taking into consideration less swings and bigger swings. You can drop the number of bars, it can take into consideration more swings. Okay, you get the idea. So, I mean, typically, if we're looking at the major rotations of the E-mini S&P, on most days you can see it from this. Okay, of course every day it changes up and down, but this is, I'm going to show you what you can do to do a study on one of your markets. So the important thing here with the zigzag tool is to change this label to change in price. Now you can actually see the delta for each swing. You can see so much. You can get so much data for each swing here. The total delta, the amount of volume that traded in that swing, all sorts of stuff. Okay, but I'm interested in the change in price, which in this case for the E-mini S&P is in points. So I mean, I can eyeball this and I can see, okay, the last few swings have been 4-5 point swings, and going up to around 8 to 9 point swings, 6 point swings, quite common. I can go back in the prior days, have a look. Okay, 8 point swing down, 10 point swing down, 10 point swing up, 10 point swing up, 5 point swing down, 10 point swing up. Now these are bigger swings. If I drop down the time frame to say a 0.5 Renko or some other time frame, you can see more swings. So most of the rotations we see on a more detailed level here will be, say, 2.5 point swings, 3 point swings. 2 to 3 point swings are very common on the S&P before we have a continuation of a move or a reversal. So we see this all the time. One of the things you can do is right click on any chart, Market Delta, export instrument data. Now, indicator data. So you click on indicator data, you choose the indicator you want to export the information for. Now you can also do this with profiles. So for example, I could export all of the information for that 1 day profile. Market Delta will automatically bring up a piece of, it will ask me to save it, and then when it opens up, I will get a little text file with all the information about that indicator. The amount of volume that traded at every price, the TPOs, open, high, low, close, etc. So every indicator you can do that for in Market Delta. It's useful if you want to do some studies. I'm not so much into statistics, but I'm more of a in the moment kind of person. But it does help to get a feel. Okay. Now I know these markets because I've traded them. I know they go up and down. volatility shifts up and down, but normally it returns to what's quite common. Now I can sit here and export the data for the zigzag tool, indicator data, go to zigzag, save that, and then it opens up and you've got every single swing. In this situation, this goes all the way back to the 9th of March 2012. So you can take it back as far as you like. Okay, as long as you've got data going that far. And then what you'll see here is that, actually it goes back further than that. It goes back all the way to 2007. Now some of this is going to lose tick data, but you can see that most of these swings, I mean, if you just run your eyes down there, see lots of 2 and 3 point rotations. Okay, the odd 6 and 7. I mean, you can run your eyes down there and have a look. Now, the other thing you can do is copy all of this data and put it into an Excel file and do all sorts of studies with it. Now, I'm not going to go into doing studies in Excel, but you can do a lot with this information and you can get a feel for the average rotations in a particular market. Every market you can do that for. Okay, so, why is that important? Because when it comes to trade management, you want to know what is high probability. What is the chance of me getting a 20-point move on the S&P? Well, it's pretty slim. So there's no point me going for that in every single trade, right? As much as I might want to take 20 points out of every trade I take, the likelihood is very slim, right, of me getting it. However, if I say to myself, I'm going to go in and out of this market, I'm looking for a 2-point profit target most of the time, there's a good chance I get it because this market makes that kind of move all of the time. Does that make sense? Okay, the chance of me going for a 6 or 7 point swing is okay, and going for that because most of the time this market will make that kind of move. It makes sense. It's logical, right? So just a little tip there for some of you. Might come in handy. Anybody find that useful? Might find it useful. Yep, good stuff. Right, and of course you can leave that indicator on. A lot of people do this. And I mean traders that are following this stuff. My mentorship students do look at what kind of swings have been made in the last day or two and generally try to target those kinds of swings for profit potential. Now, if you're scaling out, which is what I do, I normally pick logical profit targets, where I expect the market to go based upon market-generated information. But at the same time, I don't get over optimistic. I know what is expected in a particular market and what is most likely to be achieved in a particular market, and you have to know this. So, the S&P going for 6 to 7 points on a runner is achievable, even up to 10 points at times. Now, there were some times in August and September, especially August, where the market was doing a hell of a lot more than that. But that was very, very short-lived. I was short-lived. It went on for a while, but that was an odd situation. Doesn't happen, okay? Or it does happen, but it doesn't happen that often. How do you create the buttons at the top? Basically, if you when you draw a zigzag indicator, so you add it on, you have to save it as a preset. And this is how you set a button up for anything. And then the way you set up so you set up your zigzag indicator, how you need. Then what you do is click this button here, presets, new, and then give it a name. Then when you give it a name, it will show up in this situation here, in this area here, rotations. Okay. Now, when you've got that, what you can then do is right-click on a chart, add technical indicator, and then go to this option here, button. Right? And then the default should be to add or remove a preset indicator. Now, because you saved that indicator as a preset, it will show up in this list, the zig rotations, right at the bottom. And then when you add that button on, so you give it a name, so whatever you want to call it, zigzag or rotations in my case, give it a name, give it a color, add it on there, and there it is. Now I like to create buttons for pretty much everything that I use frequently in Market Builder. So it just saves you sort of right click on a chart, you can just click up here somewhere and then add it on. It's like the moving averages, I don't always use them, but I do put them on when the market's trending to get an idea of where it might pull back to and still continue its trend. In addition to the volume profiling stuff, of course. Right. Okay, so it's been about an hour and a half since we had the last break. So let's have another 5-minute break and we will continue. Any questions about this so far, guys? Nope, good stuff. Okay, 5-minute break then, guys. Right, good. Let's get started then, guys. Okay, now we've spoken pretty much about the first 4 steps of the Ultra-SD game plan. And what I'm trying to build here is a picture, a foundation, a level of understanding so you can understand how you may go into each and every single trading opportunity. At the moment, we've only really just got to the point where we can make the decision to get in. But, you know, that's most of it done. You know, I mean, I suppose most of it done from a technical perspective in terms of finding something to trade and get in. Now, of course, the result is only achieved once you have managed the trade to the point where you come out with a result. And it's at this point where you can make the most of the situation, or you can, in some cases, totally mess it up. Okay? I'm sure many of you have been there in situations where you've taken some great trades, did all of the hard work and got in, then just got out before you knew it. We've all been there. I've done it. I did a trade like that the other day. Got in and wasn't too sure, got out, and it went off. But, that happens all the time. If you're not sure, you always get out. But, I'm sure many of us have done it for the wrong reasons as well. If you doubt the setup and the reasons you should be in the trade, that's fine. Okay, you get out. But, if you're getting into situations where you're getting out of trade due to emotional responses, then that's where some work needs to be done. I'll be talking about that a little bit more so in the next topic. But trade management is essential from a technical perspective to know how to do it. You should all be very familiar with the concept of minimizing risk and maximizing profits, and I'm sure we all know that we should do it. And it's more important, though, however, to practice that. It's an old adage. Everyone knows, or everyone should know, that we should all work to minimize our risk in trading opportunities, because there is always a level of risk in every trade. And we should always look to maximize our profits. Now, to some extent, we do minimize our risk by finding good opportunities. We do minimize our risk by getting into better opportunities and timing them well with trade execution methods and the use of order flow and the price action stuff that I've just been discussing. But even at that point, we can still get the trade wrong, and it's our job through the actual trade management to see that trade through so that we can get the most that we could possibly look for in that opportunity. A lot of this should be played out in your mind's eye before you even get in. And I will often do this in the room. I'll say, look, I'm looking to get in here, and if I get in, I'm going to end up taking something off here, 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 and here. Okay, so I already know where I'm going to be scaling out and taking profits before I get into the trade. Now, there will be some situations where I get into a trade and I have to adjust my targets because I am using some dynamic levels. For example, if I'm targeting some of the developing low volume areas or value or high value or low point of control, those levels could well move whilst I am in an open trade. And in them cases, you dynamically manage your trades and adjust your targets if you need to as well. Now, there's a few methods for managing your risk and maximizing your profits through trade management techniques. Now, I've broken down trade management techniques into different categories. Some are low risk, but with a low reward, but a very high probability. Some are low risk with a high reward, but a lower probability. Some have around a moderate risk or medium risk, but a high reward potential, yet are still high probability. Then you have those that are low risk, moderate reward, which are higher probability. The methods we use to practice these different categories of trade management is all in and all out, scale in and then scale out, scale in, then all out, and then all in and then scale out. So these are probably methods that are familiar with each and every single one of you. However, you do need to understand that how you approach the market and how you manage a trade is very much defined by how much capital you trade and how much risk you can tolerate. Not only because of how much capital you have, but also from a psychological perspective. Some of us just don't like to take much risk. Some of us like to take more risk. Some of us like to look for trades that give us almost instant gratification. Some of us like to be a little bit more patient and let the market play out and give it time to play out. So it's very much a personality thing as well as how much capital you're trading as well. So not everybody will manage your trades in the way that I manage my trades. Okay, and I manage my trades in different ways on different markets. More volatile markets, I like to get in and see that market move quite quickly and then start scaling out. Something like the DAX, very much my normal approach has been for quite some time to go all in, and I didn't trade the DAX that big. Okay, I would trade with around 4 contracts and scale out. And that was enough for me to reach my objectives. It was within my risk tolerance levels. Now, something like the DAX is very volatile. You need around 20,000 US just to trade one contract. I know some traders try to trade it with less, but it's a very volatile contract. It's a lot more volatile now as well. So it's a huge contract. The value of that contract is huge, and although it's only 12 US 50 a tick, it moves a hell of a lot. And that can work for you and against you. Now that means with bigger size, it could mean a lot more risk. But at the same time, on a market like that, the profit potential is also increased because of how much it can move. So, just to give you an example, I look at 4 contracts on the DAX as the equivalent to 20 contracts on the US stocks. It's around about right. If you look at how much you're looking to gain in around a similar time window on a 5 contract position on the DAX, when you have one contract on the DAX and a 5 contract trade at the same time on the Euro stocks. So sometimes it's more, sometimes it's less, but give or take. It's like the Dow as well. It moves more in ticks. It's $5 a tick, but 2 contracts is like trading 1 contract, taking into consideration position size. The size of that contract per tick, as well as how much it moves in reference to the S&P. So every market is different. Some markets you will have to trade smaller, some markets you will have to trade bigger, even if you have the same account size. So just because you have an account that is capable of trading based on risk management models, looking at risk of no more than 1% per day, up to 2%. Based upon that, you might be able to trade, say, 20 contracts on the E-mini S&P. but that doesn't mean you can trade 20 contracts on, say, a market like the DAX. So you do have to understand that every market is different, and you need to understand how much you can trade for each market. And you need to know how much you can trade before you look at trade management, because that will define how you can scale out of that trade and also get into that trade as well. So a few different methods: all in, all out, which is probably the most popular approach. And I think over the years, the scaling out method has become more popular as well amongst traders. I don't know what every trader out there does, but just going on what we hear and see. Then we have the scale in, then all out method as well, which is build a position by scaling in, and then once you get to your target, which you plan to get to, you get out. And then you have the all in and then scale out method. Now, I very much use the combination. I like the idea of scaling in and then scaling out. That's the approach that I take. And on markets, there's nothing wrong, firstly. There's nothing wrong with going all in, then scaling out. Nothing wrong with going all in, all out, and then there's nothing wrong with scaling in and scaling out. It's very much a personal preference thing. You might have to try different methods before you find what works most best for you. And you might also find that in certain situations, on certain markets, one method is better than another. So, you know, it's not always use the same thing on every market and every single trade you take. So, like I said, trading is very much an art form. But at the same time, if you want to simplify things from a trade management perspective, the easiest way to start, especially if you're just getting used to trading and looking to start out in your trading career, getting onto the path to consistent profits, the simplest thing to do is go all in, then all out. But understand the harmonics of the market and understand what is high probability. Right, so I'm just going to go through some examples there, some diagrams to give you an idea of what this might look at with each different method. So this is what I would class, and this is not written in stone. This is purely my own classification for each one of these different styles. I would personally look at an all-in, all-out method, which is getting out at a short profit target or a very close profit target. So that could be the E-mini S&P going for something like 4 to 6 ticks, which is very high probability you'll get that kind of move all of the time, okay, or very frequently anyway. Okay, so it's a low risk trade because, you know, in this kind of situation you go all in. You probably take the same kind of risk as you would for your target, so in terms of ticks or points. So, you know, if you're looking for 4 to 6 ticks, you probably don't want to risk more than 4 to 6 ticks. It's like a 1-to-1 risk-reward ratio. So a lot of traders start this way, and this is actually the method that I recommend for developing a feel for the rhythm of the market and trade tuning. You get in, get out, get in, get out. Your risk-reward parameters are pretty much 1-to-1. You risk 10 ticks to make 10 ticks. You risk 6 ticks to make 6 ticks. That kind of thing. You might skew it slightly either side, but, you know, ideally you want to skew it a little bit more potential reward rather than risk. So you might risk, for example, 6 ticks to make 8. You might risk 10 ticks to make, say, 15 to 20 ticks, etc. But, you know, you're not looking for too much in terms of a profit target. One of the things you'll realize in trading is that, and this is if you haven't already done so, is that shorter profit targets seem to get hit more often. Closer profit targets seem to get hit more often. You know, that's just that's a given, pretty much for any market. You know, you've got a much better chance of getting 10 ticks than 100 ticks. Okay, you've got a much better chance of getting 1 point on the S&P than, say, 20 points. Does everybody agree? Yep. Good. So this is why I say this is high probability. There's a very good chance if you've got a, you know, it's like selling the VWAP unfair high or above value and going for the VPOC or the point of control. Trading from the unfair high of the range for the retail price. Trading the unfair low of the range for the retail price. There's a very good chance you'll get that. And it's very high probability. Now, if you're looking to become a scalper, this is a great way to trade. You know, it's a short objective. You're going to get it often. It's high probability. And for a lot of traders, this suits them because a lot of traders like to be right. So high probability strategies make sense. But taking a lot of not taking a lot of risk is also an important concept, especially for new traders. So I recommend that everyone start small. I don't know where you are in your trading careers right now, as I've said, but if you are first starting out, or you just haven't been consistently profitable and haven't found your niche, then I would recommend you just drop your risk all the way down to a one lot, or even if it's smaller size, but just going all in, all out. Just get used to developing a feel for one market, and get used to getting in and getting out for a profit more often than not. The thing is, this is a good starting point for every other method of trade management, because if you have a level of high confidence and you believe that you can reach your first objective very often, then that really does help when you move to the other methods as well. Because if you're scaling out, a lot of the time your first target will get hit, yet your second, third target might not get hit. There might be a situation where your first, second, and third target gets hit, but your fourth target doesn't get hit. This happens all the time. It happens in my trading. I don't always get to my final target. I've often said that I get on my final target probably less than 30% of the time. Most of the time I get my first, second target, and in some situations I end up getting my third target as well. That doesn't mean I stop doing business in that way. It pays off for me to go for that third, fourth target and maximize my profits. You have to remember, when you are scaling out, you're pretty much at no risk for the remainder of the position anyway. But it requires the mindset to be willing to give back some profits, or willing to give up the chance for a certain gain to make more, which actually is covered heavily in the Ari Kiev books, and that's why I recommend you get those books, Psychology of Risk, Mastering Market Uncertainty, and Trading to Win, because those two books will cover the concepts that I talk about, and that will help you develop the right kind of mindset. Now, the books alone, reading it and understanding it won't help you, but you do have to apply the concepts. You have to understand it and apply it. And that's with anything. It's like what I'm teaching today and yesterday. You have to apply it. You have to begin to apply the concepts and see them start to work for yourself. You have to build belief and confidence in it as well, right? So this is a low risk, low reward, high probability approach. All in, all out. It's very much a scalp. Okay, it's just a short-term profit. You get in, get out. Most of the time, these trades are over quickly. High probability, but low risk, but also low reward at the same time, and that's the key point. It's still low reward. The downside of this kind of trade management is that you will take some very good trades, and a lot of the time, these trades will come off to be some big winners, and you're sitting there out of a trade, and now you have to look for the next one. And what ends up happening for most traders when they have this approach is that they end up fighting the bigger move. So it's important that you do take these trades from a shorter time frame context, trading the smaller rotations, not necessarily, but at the same time recognizing that if you are trading against a bigger context or the larger context, just be aware of that, and try to position yourself within the context of the bigger time frame. So try and trade in line with the bigger picture. So although you're going for a shorter profit objective, try to still understand what's going on in the bigger picture, so you don't end up trading against it. Okay? It's, however, not as important as if you're looking for the bigger moves and looking to scale out and go for further profit targets. But it's still essential to know. You need to know where you are trading within which context, even if you're going for smaller profit targets. But like I said, the downside of this is that you will often end up taking a trade, and it's a very good trade. It could be the high of a big move down. It could be the low of a big move up. Okay? And now in those situations, what you have to do if you go all in, all out like this, the small profit target is very much scalping. You have to go with the direction of the trade. You have to go with that bigger move. If it's moving directionally and it's going to a certain target, and you anticipate it going from a certain place to a certain place from the bigger picture, you keep trading until it gets to that final target. Okay? Trade in line with that bigger context, that bigger vision. Now, the next option here is slightly different, but very similar. You're all in to a trade, so you go in with all of your position. Now, this is low risk because you go all in and you pretty much want to put a stop above the highs. So, your risk area will generally be, you get in here, your stop is up here somewhere. Now, if you use the order flow concept, you'll actually use the order flow to get out. So, if you see lots of sellers hitting the bid, you get in here, and all of a sudden, wait a minute, the buyers start lifting the offers, it starts coming back to this area starts going offside, you can get out. If you can clearly see the buyers are against your short, you can always get out. So now if you're all in and you're all out, or you're all in on any trade, it's important to manage your risk more aggressively. You have to be more aggressive with getting out of your trades when you can see you're wrong. You don't necessarily have to wait for your stop to get hit. So in this situation, if you're trading above value, you might go for the value area low as a target. So you might go for an exit on the other side of value. Now that's higher potential reward. The potential in the trade is greater, and if it comes off, it's great. But the only thing with this, when you go for big targets, let's just say this 100 tick range, and you're getting in here with, say, a 20 tick stop. The chance of you getting that 100 tick trade is going to be quite slim. So it's low probability. But if you can stomach that risk, that 20 tick risk or so, this is just an example, let's just say stomach 20 tick risk, and you are willing to allow for yourself to get stopped out more often than you actually hit your target, then that's okay. You can take 3 20 tick losses, be down 60 ticks, make 100 ticks, and you're up 40 ticks. Now this is a low probability method, but if you can pull it off, it can still work and be profitable. But most traders won't have the ability psychologically to be able to stay with a method that has a very high potential reward but is low probability. Right? So what's the next option? Next option is you can go all in. So for example, you saw 2 contracts here. You take your first contract off here, and then as you hit your first target, you bring your stop closer, or even at break even if the market's moved quite significantly, and then you go for the second exit down here. Now this is higher probability because even though you may not always get your second target, there's a good chance you're going to get your first target. And with your second target, there's less risk than you had initially when you got into the trade. So it's moderate risk. It's a little bit more risk because you're selling to, and there might be situations where you sell to, you get your first target, and you get stopped out. So you might give back some of what you just gained on the first target. Okay, now if you put your stop or break even, that may not happen, but you'll get your first target. But what may happen with this model here is that you sell to, get your first target, and the next trade you sell to, but you get stopped out. Now you've given back the gains of a trade. The thing with this though, however, is it's high probability. You're probably going to get more of those trades right. So it's a numbers game, and you have to stick with that model until your winners can start outweighing those losses. Okay, and this is only purely from a trade management model perspective. There are a lot of different techniques you can use to minimize your risk from using the order flow, etc. And you can get out of these trades without suffering too much of a loss. I share these examples in the room. There are times where I'll take more risk and it doesn't pay off. Sometimes I'll take more risk and it pays off. Meaning that, for example, I might be in a short here. I might take my first target, but I'll leave my stop up here. And, in that situation, I might give back what I've just gained. But more often than not, giving that market some space and believing in the market auction market theory principles and trading the market structure, I know when the market comes up here, there's a good chance it might come back down again. So sometimes the market may want to retest these areas a number of times. And, this is where scaling in really helps. So this is an example of scaling in. So in this situation, you might sell one here. You want to get something on just in case the market goes. So either way, if the market comes off, fair enough, but you've got a smaller position on. You'll still take your target. Okay? Now, in this situation, what you won't do is put a stop up here. What you would do is almost the reverse of what most traders do. Rather than get out and get taken out by the stop run, you actually sell more. And now this becomes very high probability. It increases your probability of the trade working out massively. Now, but the most important thing to remember here is it's not my maximum position size is 2. I'm going to sell 2 here and then sell another 2 here. And I'm going to be short 4. That's the most important thing to remember. When you are scaling in, you don't average down or average up. You're not building a position to the point where just because you don't want to accept the loss. It's not the point. Okay? It's important to distinguish the difference between scaling in and averaging in. Scaling in is building a short or building a long below value. It works brilliantly if you trade around the value trading method model, that framework, because we often find the market will, especially in these more volatile phases, and this is where I've really adopted this approach. It's been an excellent way to manage trades and get into trades and allow for the market to move around a little bit and not get shaken out. But also it's a great way to work in bigger position sizes without taking too much risk on the offset. Now the downside of this is if you get short here and this market ends up giving you a big move from here and you've only got quarter of a position or half a position on, now you have to scale it in as it's moving in your direction. Sometimes you don't get a chance to do that. So you have to be willing to scale in as it's moving in your direction as well as moving against you. Okay, there was an example that I showed you earlier on the Bund as I shorted some at 44s and then I shorted some at 40s. That was a sign of that was very much like this. So that's this model here. It's low risk, but it's moderate reward, but it's very high probability again. So I'm going to take some short here, but I'm going to get short smaller. And then as I get extra confirmation, I'm going to add the rest of the position in, which is probably the best way to approach it. That way, when you can afford to be a little bit more aggressive with your first entry. So even if it doesn't move in your direction, moves against you, you can still sell some up here. But if it does move in your direction, you can still sell some lower and still build your position. Right? So this is the scaling in and scaling out. So the only difference here is that you're building a position at different prices, but you're exiting at similar targets. Does that make sense, guys? Now let's have a look at an example of the benefits of this. How might this help you out? Let's just have a look at this. I mean, how many of you guys have taken trades where you have got in and found yourself take the right trade in the right area, but you happen to get stopped out pretty much to the tick, or the market takes you out because your stop is above the high and then moves in your direction again? How many of you have experienced that? So let's just say you got short here and your stop's up here. The market moves in your direction, but then moves against you and then takes you out and then moves back in your direction. Happens all the time. It's a very common occurrence. So why not use that if you understand the auction market theory principles and believe in them to your benefit rather than disadvantages? You do use it. Okay, so this is what I did. If I get short here, I might short 20 contracts, scale out 10, 10. Okay, I'm out. Okay, I might get short 20 contracts here. Let's just say I got short 2 contracts. I want to build a 4-lot position. I got short 2 here. Okay, comes off, took the first, second target. I'm flat. Okay, that's fine. I look for the new short up here. Let's say I got short 1 contract here, but my profit target was further away and it didn't get hit. I'll get short here, 1 contract, comes back up, but my full position is 2. I'll short another one. Then I still can get my targets. Okay, but the thing is, it does save you some hassle. Now, this is an art form. I wouldn't recommend anybody just start doing this. It takes some practice and some experience, and you have to have, before anything else, you have to have a lot of confidence in your understanding of the market, because you can't build a position when the market is moving against you if you don't believe in what you're doing. You can't. But if you do, and you believe in what you're doing, and you know what you're doing, you understand the market really well, more often than not, it pays off. It's very, very high probability. So let's just example here. We shorted 1 lot at 13.69s. Now with this, stop would be at 13.71. So 2-point stop, 8 tick stop, which is $100 on the E-mini S&P, $12.50 a tick. we got a chance to profit at, say, 67s. Okay, 2-point target. We're going to go for $100 profit target on a one lot. That's okay. If it comes off, we'll get the $100. Okay, that's fine. It's a 1-to-1 risk reward ratio with a one shot of being right. Now we either have to get it right here, or it's over. Okay, we're either going to get stopped out or we're going to hit our target. It's 1-to-1. However, if you give yourself a bit of flexibility, you can say, okay, I'll short half of my position here. I'll short one here. If I get my target, I'll get my target. But just in case this market wants to push a little bit higher, I'll hold some of my position so that I can short it at higher prices. So what you do is you get short here. Okay, let's say the market pushes down, but you don't get your target. Pushes back up, you short another one at 71s. So you scaled in, you didn't take this profit target, shorted one here, market comes up, short another one at 71s. This is just a hypothetical example, but it's obviously a real example if the market actually did this. This is very much similar to what I do in most days, as most of you guys are aware. Now, I'm not always scaling in as the market moves against me and building a position in that way. Most of the time, I'm not. Most of the time, it's moving. I want it to move in my direction. I want a high probability trade and a high probability area for new business. But this might be a longer time frame area, and I've said to myself, okay, on a 60-minute chart, you know, I want to work in a short between 69 and 72s. So I will highlight that before the market even opens up. I'll say I'm going to short in this area. I'm going to build a short position. And as long as it doesn't get out of that range, I'm not wrong. And I'm going to build my position as long as it keeps looking right. Okay? That's what you have to do. So you have to understand market structure. This is not just sell at higher prices and hope and pray the market turns down. Not the same thing. Very important to take note of that. Okay, so here's an example. Okay, let's just say a second lot was shorted at 71s. So rather than putting a stop here, so rather than shorting one here and putting a stop here at 71s, because this is what normally happens and it's quite common. We see it all the time. You know, the market does this. It's a 1272 extension. It's a stop run. Market can't find sellers again here. Does a stop run, pushes up, finds the sellers higher prices. So we've got to use the auction market theory principles to our advantage, not our disadvantage. So, you know, here we are shorting 69, 71s. Now we've got two lots on. Now, the average entry price will not be 69s. This is important to remember. If you shorted 69s with your first lot, when you short 71s, your entry price doesn't stay at 69s. It moves to 70 because you shorted one lot at 69s, shorted one lot at 71s. The average of that is 1370. So your entry price moves up, which itself is an advantage of doing that because it improves your entry price. Now your stop can be higher at 3072s with two lots where you've added in a little bit more risk, but at the same time you didn't have to stop out. So you didn't have to stop out, and you've given yourself, it's almost like a lifeline. You've given yourself the ability to now stay in that trade and the reason for being in that trade in the first place. Because the reason you got into the short is because you're expecting longer time frame sellers here. But they might not necessarily be right here. They might be a little bit higher. So this is what allows for you to take advantage of that. You know, you shouldn't be penalized for being early. You take advantage of that. So you sell and build your position at a higher price. Now it does add more risk because you've increased your position size. But that's the whole point. That's your full position size. You want to put your full position on. Okay, but the trade still has potential for a good rotation lower. But now you've also gained these benefits. A higher, better entry price. Your entry price was originally 69, now it's 1370. You've also gained a greater profit potential because you can now scale out at 60, 68 and 66, increasing your chances of getting a profitable trade. Now your profit potential is around $300 rather than just $100 on the one lot. But your risk is still lower, being at $200. Now you've increased your risk reward potential, you've increased your entry price, but you've also increased your chances of getting the trade right because you can now scale out, etc. Right? High probability to play off as a range extension stop run has taken place. So after the stop run has taken place already, you have a greater chance of the trade also playing off as well. So simple concept, but very effective. You can apply that on any market. Right? Does that make sense, guys? Any questions about that? Now, I'm not saying you have to do this or you might do this. I'm saying that you might want to consider averaging in, scaling into your position, not averaging in. You're not building a bigger position than you should have. You have to know what your risk limit is. You have to know what your full position size is. For example, if my full position size on the E-mini S&P is 40 contracts, I don't have to go in with 40 contracts in every single trade. I can use position sizing to my advantage by going in smaller chunks. And as the trade looks better and it moves in my favor, I can add in and build the position. I can add in also if it goes against me. I'm building a position in an area where I expect some action to take place for the bigger move. Right, does everybody see the benefits of that? Now, I'm not saying you have to do that. I do it and I see the benefits of it. That's why I share it. It helps me out greatly when I don't get the trade right in the first place. But now, the thing is, psychologically, it helps you out a hell of a lot because you can be a little bit more aggressive on your first trade, and even if you don't get it right, you still haven't got it wrong, if you see what I mean, because you haven't put your full position on. So that's, for me, is a massive benefit. Now, if anybody don't see it, I don't know why you don't. It's a massive benefit. There's no need to be right straight away. You can allow for that market to still move against you a little bit and still build your position because you haven't got fully short. You haven't got fully long. You're using the market structure to your advantage because the market doesn't just move, especially on the bigger moves. It doesn't just pop up and pop back down. Yeah, there are some trades where it just goes, okay? But even in those cases, there's nothing wrong with having 2 lots on instead of 4. You still get a profit out of it. I mean, I'm going to show you guys a trade sequence here, which was taken during a time where I've been scaling up to around 8 contracts or 10 contracts. And this trade was taken specifically a little bit ahead of the market open. But you can see how just, scaling in, it was up to around 3 contracts at most. 3 contracts. And I scaled in with 1 lot, then a 2 lot was on, then scaled out, and then scaled back in again and scaled out again. But it gives you so much flexibility with the position. You don't have to go all in, all out. You don't have to go all in and then start scaling out. You can scale, you can get in, you can start scaling out, you can lock in some profits and you can add into the position as well. Trading is an art form, and if you have confidence in what you're doing and you understand the market structure really well, you should be willing to build positions with greater profit potential if the trade still looks good. So intraday. So for example, if you're trading 4 lots, you would scale in, say, 1, 1, 2. Yeah. So I'm going to show you an example now. There's a video clip of a trade that I actually took. This is sometime in October, I think it was, but it was taken ahead of the room open sometime, I think it was, and I ended up coming into the day and I said, look, I've already taken a couple of trades, but I've locked in, I think it was about $425, and I started to work in the rest later on. Now I only need to take 1 more trade. I think I took another 4 lot trade afterwards, and that was it. My objective, remember, in October, September, December, was only $1,000 a day. It's very small, but I was hitting it almost every day. But I was trade tuning. I was only going for $1,000 a day because I'm trade tuning. I'm getting used to the E-mini S&P again. I'm getting a feel for the market again. Okay. So yeah, so you can scale in 1, 1, 2 at each level. I mean, you don't necessarily have to go as far as only scaling 1 lot at each level. I mean, you might want to put in at least half a position here in this situation. If you're trading smaller, ideally you want to get at least something decent on. So if you're only trading 4 contracts, you ideally want to scale in 2s, put a 2 lot on, and then maybe put a 2 lot on somewhere else. Okay? But, ideally if you're trading smaller, meaning like, 4 contracts, 3 contracts or something, you want to scale in around the area, around 1 level. So if you're scaling in, say 2 lots, you put 2 lots in this area and look for that rotation down and start scaling out. If you're scaling in 4 lots, you probably put in 2 here and then want to add maybe 2 up here. Now if you're trading, say, 40 contracts as a maximum position size, you don't always have to go in with that 40 contracts. Most of my trades are half a position or 3/4 of a position. There's no rule to say you have to go in with a full position every single trade. I would go in with 20, 30 contracts on a lot of trades and still hit my objective. So I would only go in with a full position on those trades where I feel that I'm very, very sure and I want to put it all on. So I hold back on a full position on most trades. So just because you can trade 40 contracts or 50 contracts or 100 contracts doesn't mean you do on every single trade. Now, just because you can trade 4 contracts as a maximum position size doesn't mean you use your maximum risk in every single trade. Right? Which is it's okay if you do, okay? But you want to give yourself a little bit of flexibility. Because the thing is, the markets are not perfect. And we are not perfect when it comes to trade execution. And this is why I said earlier on, when you look at trade execution, you might want to allow for imperfections and even be a little bit aggressive sometimes by understanding that you're going to manage your trade in a certain way. Now, don't get me wrong here. I am not saying that you can't go all into a trade. You can, and I will at times. So don't get me wrong with that. I'm saying it's a technique that you can use. It's one technique out of many for trade management. Okay, it's one technique, but it doesn't mean every trade has to be put in this way. You might go in with 3/4 of a position. You might go in with a full position in each one of these trades. If you go in with a full position, there's nothing wrong with that. The most important thing to do, if you're going with a full position though, is to manage your risk more aggressively. If it goes against you, you get out quickly because you have more risk on the table when you have a full position on. If you guys notice, when I take my full position trades in the trading room, I get out very quickly. On the E-mini S&P, I will hardly take more than 3 to 4 ticks risk on a full position. Now, if I have a half a position on, I will let that market move 2.3 points against me and still not be phased by that level of risk, because if your full risk on a full position is 2 S&P points, on a half a position, that means you can accept a 4-point push against yourself and still be within your risk tolerance. You can still be within your risk parameters. As long as you're never taking more risk than you can be allowed to take, which is no more than, say, 1% per day, okay, but based upon that, you might be risking 0.25%, 0.5% per trade. There's no problem with adding into a position or building a position, as long as you know what your risk parameters are. Now, it becomes a dangerous game only if you scale past. Now, let's say you're fully positioned here and you keep adding as it moves against you. That is not what we are talking about here. That is averaging down or averaging up, and that's dangerous to your capital. That's the unwillingness to accept that you're wrong. If I'm wrong and I'm fully positioned, I get out. It's as simple as that. But until I'm fully positioned, I'm going to be looking for places to work in the rest of my position. If I can get higher prices for a short, that's better for me. If I can get lower prices for a long, that's better for me. So, and I often say that in the room. I say, look, I'm going to get short here, but I actually want the market to move a little bit higher and go against me, so I can short some more and build a position at higher prices. I say that all the time. Some people that don't understand this from a risk management, trade management perspective may not quite get that. So you need to understand that. Okay? Does anybody not get this? I didn't hear any people say that they did get it, so let's ask the other question. Right, good. So what I'm trying to get at here is, firstly, you can allow for imperfections when it comes to execution, but just don't get fully positioned, and especially when you're getting used to, well, you don't have to. There's no need to be completely right with every single trade, right off the offset. Now, you can use the order flow and execution methods that I've shared to help improve your chances of timing the trade right and better, but it doesn't matter if you don't, okay, as long as you're not fully positioned. Now, if you are fully positioned, just make sure you get out quite quickly. You don't have to wait for your stop to get hit. Okay, now, this is an example here. This video might start running, actually. It might be okay if I do it this way, but it might be a bit slow. Actually, what I'm going to do, I'm going to do it in both ways. It's just a simple trade execution example here on my dome. This is when I was trading quite a bit smaller, but still a free contract trade, which is pretty much similar to what most of you guys will probably do. But it's a good enough example. It doesn't last too long. Now, if I put on a trade here that I'm in here for 2-3 hours, which a lot of the time I end up being in trades for a long time, Now, if we're going for the third and fourth target, you probably won't hit it this quickly, right? So now just understand this is just a first and second target trade. It's about a 3-point rotation on the E-mini S&P, just getting the first target. Then it moves up against back to break even again. Rather than get out, what I do is add back into the position, then I scale out the first target again, and then I'll get the second target. So a very quick example here of how you would manage a trade yourselves. Now, some of you guys may want to watch this, and I would recommend that you watch this with the link that I shared earlier. But let me share that link again, because it will be so yeah, I mean, a lot of time in October, November, December, I was scaling into trades with 2 lots, then 4, then 6. I very rarely, most of my positions, even though my full position was like say 10 contracts, most of my positions, even though I had a target of $1,000, never went above 4 contracts. That was the most I traded on most days, because I didn't need to get bigger than that. To hit my objective, my goal as a trader was to only hit $1,000. Okay, my goal was to reach an objective of $1,000. Okay, once I hit that, and remember this is also alongside the trading that I'm doing on the Euro stocks in the mornings. So this is a good example here. You know, you don't have to trade big. $1,000 may for some seem like not a lot on a daily basis, but you know, for some that's actually a good place to start. I mean, actually that's a very good place to start. That's actually better than a good place to start for most traders. If you're going to reach a $500 target a day, you're doing well. But yeah, most days I was going for $1,000, and almost 90% of the days I hit that, right? And I was only scaling up to around 4 contracts in most situations. But just because my maximum position size was 10 contracts, I very rarely traded a 10 lot position. The max I went to was, on most situations, 70-80% of the time was about 6 contracts. Most of the time I had 2 to 4 lots on. I didn't need to trade bigger than that. I could hit my objective with 2 to 4 lots in most days if I managed to trade well. So you don't have to trade huge. Okay. So good example here. Let's just share that link that I shared earlier. If you guys are in there, then you can see that there. If you guys can't get in and you have issues with it, you'll have to watch a video here that I'm going to present via Instant Presenter, but it might be a little bit slower. Okay, so it might be a little bit lagging. But yeah, I mean, it's certainly only one trade sequence. Every trade is different, but it gives you a good example of how, if you're looking at some of the depth information. Now, the depth was a little bit thin here because it was before the cash market opened up. And as you can see, they've got, you know, just a few hundred on the bid and the offer, but it's still tradable, and you can still see. And in this situation, what happens? I think I get short around 42's half or 42 quarter or something. Then it pops up to 43s, and 43s becomes my reference level that we can't trade above. 43, we can't take it out. So I was not, and I'll say to myself, well, whilst I'm in this trade, my thought process is, okay, we hit 43s, we can't take it out. As long as we're not taking out 43s, I'll build a bit of a position. So, you know, let's just imagine we have some resistance, say from around 42s up to 44s. It's an area of low volume. And actually we do have an area of low volume, because if you look at this, on the right hand side here, oh, what's going on here? Starting to freeze up a little bit there. Now, if you have a look at there, I do have the volume profile up, but I don't have the visual version. I have just the numbers. So you can see the amount of contracts how they've traded at that price. So what you can see from this, oh, the link from the earlier presentation, or the link that was shared earlier on, I'll just post it up again if anybody missed it. Here it is. So that's ideally where you want to watch it, because it'll be more real time, it'll be quicker to update. So click that link, that will open up in a separate window. Now if you can't view that, then just keep an eye on Instant Presenter and keep an eye on that window and you'll see it there, but it will be a little bit slower. But I'll keep pausing it every now and again so you can just see it and allow a bit of time for each one of you to catch up. Okay, so I've just got it started. So what you notice here is there we are, 42.5. It pushes into that low volume area, and I'm looking for an entry here. I can start to see it's starting to reject the 42.5 area. There we are. Then I'll get my first contract on. Okay, so that's a bit of a sign that 42.5 is starting to hold, because it popped up into it, pushed back down, popped up into it, pushed back down. So that's my first sign. Okay, and it's very aggressive to just get short there, but I've now got at least a contract on. Okay. So let's start it up again. Then what you see is me sort of eyeballing the 43 area and watching what's happening as price is trying to move up there. And then I'm watching also, you know, are we able to lift through the 42.75, 43? Then we lift through the 42.75, but we can't get through the 43. There we are. We hit the 43, but we down tick. We push all the way back down to 42 halves. Okay? Then all of a sudden, 43s to me is now rejection. It's like seeing a topping tower on a price action chart. Then I end up somewhere here shorting another one. Starts trading higher, test the 43, starts pushing higher. But it can't push through that 43. And then at some point, you will see that I'll add another one in. So they're short too. Okay. Let that catch up. At some point, some of you guys will see that it goes to short too. Now this is, I mean, this is streaming a video online, so you have to bear with it. But you'll get the idea. Then I'll put another one in at 42.25. They're short too. Okay, so some of you guys are going to be seeing this a little bit later. Some of you guys are going to be seeing this a bit earlier. But the main idea is that you see it at some point. Okay. So let's leave it on. It starts to move. Now this is where I start putting some targets in. So I start putting a bid at that low volume area at 41.25, and I'll put another bid in at 39.5, which is the low volume area below. You can see already what happens there. The 41.5 or 41.25 got hit and actually got filled. So the first target gets taken out. Okay. At some point, all of you should catch up and see that. Okay. I'll pause it again. So now there was short two, but covered one. Okay. But still got a target down there at 39 halves, the next low volume area. Okay, what you'll see what happened now, the market then comes back to break even again. Now, there's no point me putting a stop at break even here because the market's barely moved. It's moved, 4 or 5 ticks in my favor. If I put a stop in a market in this kind of phase where it's quite volatile at times, I'm just going to get stopped out. So the worst thing you can do is put a stop at break even too quickly, because that's just asking for trouble. You're going to get yourself taken out frequently before the market even has a chance to play off. Now, there's nothing wrong with that as long as you get back in again. But most traders don't get back in again, and that's the issue. So you need to either put your stop at break even and get back in again, or don't put your stop there in the first place and just watch what the market does around your area for, at break even. A lot of the time the market will come back to break even. We see this time and time again. It will come back to break even test against your entry price and still hold. Okay, as long as the reason for being in that trade is not over, you stay with it. So let's keep going. What we'll see is it will revisit. I think it revisits around the 43 area. I'm not quite sure exactly where it was, but it comes back up again. And I will improve my entry price with the next entry. Now, only by a tick or two, but it doesn't really matter whether it's scaling in at break even or slightly as the market's moving for me or against me. It's still in my area for doing business, and that's the most important thing. So, here I'm looking at 43s holding. We get back into that low volume area. Still can't get through 43s, and this is where I'll get a fill for that again, and I add another one short somewhere. Okay, there we are. Okay, and now the entry price changes to 42.5. When you see that catch up on your side at some point. So it might be moving quite slowly on your end, but give it some time. I'm watching this on another PC here, so I'm getting an idea of how slow it might be, which is quite slow. So that's why I prefer the other method, but it doesn't look like many of you can get into that, so that's why I'm doing it this way. Okay, so it comes back to 43 at some point. It's keeping up well, so most of you guys, maybe it's my PC that's slow. Anybody still behind? Is anybody still waiting for this to pause? Maybe that's the best question to ask. You should all be looking at an entry price at 42 halves. Okay, good. So we're all pretty much there, right? So good. So, you know, you got 2 on again. So shorted 2. So, you know, really I don't get bigger than 3 contracts here. It's a small trade, but, you know, it's a modest profit and target, modest risk. Actually, not a lot of risk considering what actually happens in this trade. Not a hell of a lot. You know, it's the kind of thing that most of you will look to do when you first start out. Now, most of you, I say some of you, most of you, or some of you may want to just trade a 1 lot and not scale in and out. That's fine, okay, to start off with. But, you know, if you start getting a little bit bigger, just 2 to 3 contracts is a good example of, you know, the kind of way you might approach it. So, okay, now what I'll do is put another target again at 41.5, which is 1 point. Okay, so I'm going to lock in 1 point again. Oh, this is a good, this is something that I want to discuss. You guys can see there's a number next to my bids. 1,043,916. That's how far I am in the queue. So you can see 1,043. There's actually 1,078 actually sitting there. But I'm actually pretty far back in the queue. Then, you know, you can't see how much is sitting there at 39.5, but you can see because I put that order in early, I'm a little bit further down the queue, okay, as a limit order. Now, it's important when you put your profit targets out there that you put them in as early as you can, really, because you want to stand a better chance of getting filled on the bid when it gets there. There are times where you'll get to your profit target and you won't get filled. I mean, it happened to me on Friday. The idea is to watch it when it gets to your profit target and get out. If you feel that you might not get the fill that you're looking for, you might not get the fill that you're looking for at that target, it's okay to accept a tick or 2 less. I do it all the time. Most of my trades will involve me getting out a little bit earlier than my profit target, initially where I put my target. Because quite often those targets are key rejection areas. And we don't always get into that area right to the tick. So, I mean, in this situation, you'll see the low volume area is 39.5, so I put it right there on the edge. But in this trade sequence, I end up taking it, I think, at 40s or 39.75 in the end, because I see a little bit of support coming in around 39.75. Now, I mean, in the end, it does actually hit through the 39.5, and that sometimes will happen in your trades. Happens to me all the time. So, you know, but at the same time, don't be a dick for a tick. If you can see the exit there, you can. Market if touched order. But yeah, market if touched orders only get filled. Buy orders will get filled on the offer. And sell orders on the bid. Well, as far as I'm aware anyway. Unless I've got that wrong. That's what I understand. I mean, it wouldn't make much sense for them to get filled ahead of a limit order. Okay. Yeah, I mean, it's market if touched, so it's a market order. If it's touched there, you get filled. And that's pretty much what happens with a stop. A stop market takes you out on the offer, on the buy stop, and a sell stop takes you out on the bid. So, I mean, here the 41 halves get hit again, so the first target gets hit for the second time. And again, this is locking in incremental profits. I mean, you can see here, because I'm still in the premise of the trade is still right, we're looking for the 43 area to reject, short at 42 half. It doesn't make sense for me, if I can get a chance to scale out again, and look for another attempt to lower, I might as well take it again. I might as well add into it and put some more on. So in this situation, I do this all the time.
if it comes back to my area for doing business, I don't need to get out. If I have a good enough reason to be in that short in the first place, and I'm a strong holder, coming back to some of the stuff I shared yesterday, I should actually be looking to short some more and build my position again, at least up to a full position, or at least get something on again. There's no reason for me to hold 39.5 as a target and not take something again if it's going to come out at 41.5. It just doesn't, this is common sense, really, more than anything else. So at some point it will hit 41.5, so you've got to be patient. Now this trade doesn't take that long. I mean, these days trades are taking a long time. I mean, I'm sitting in there for hours just to get my first and second target. Well, actually, the first, second target usually gets hit within about a half an hour period, but the third, fourth target can take a long time these days. Market's not been moving. This is ahead of the market open, so there's less liquidity, so the market tends to get through the prices a bit quicker. I don't want to sit here and show you a recording of a trade that lasts 3 hours, otherwise we'd be here forever. But you guys get the idea anyway from this. It starts trading lower, so it's taken out the first target. Can most of you guys see that? Anybody still sitting there waiting? We should be sitting there around 40 halves now. Trading around 40 halves. Still got one lot on. Everyone should be catching up. Everybody catched up? Everybody caught up on their videos? Right, so we've taken out 2 contracts out of 3. Locked in some profits, but we're riding out for this low volume area here, and here we hit 39.75 or something. And notice here, I only put my stop in now the market's moved quite far away from break even. I do put a stop in now. I go ahead and put a stop in, but only when it's moved significantly away from my entry area. I don't want to put a stop in when it's just like 2 or 3 ticks on side, even 4 or 5 ticks. If you're too eager to put your, that's a trading not to lose kind of mindset. It's like, I don't want to take any risk and I don't want to give up what I've just potentially got here. But you got to trade to win. You got to have some belief and confidence in what you're doing. So here we are, continues, put a stop in now, and I end up taking the next target here manually and just pull the other order, which is what I do a lot of the time. Okay, and that's the end of trade sequence. Now, that's the kind of trade most of you will take if you're trading just 2 or 3 contracts or so. Not looking for much more, not looking for much less. It's about right. 42 halves to around 40s. It's about 2.5 points on the S&P. Is about 10 ticks, and you're going to get that quite often on the S&P. Right. Hope that makes sense. Okay, so just one short example there, but gives you an idea of how to just watch what's happening on the dome, put a trade on, build a short, start scaling out and locking in profits. Nothing, not a huge trade or anything, just trading in some small size and getting out. But you get the idea. Doesn't matter how big you're trading or how small you're trading, it's the same idea. And if you're trading a 1 lot, you just get in and then you put your target in and you pretty much put your stop in. You don't have much of a choice when it comes to trade management if you're just trading with a 1 lot, right? Or you're trading all in, all out. Now that's the thing when you're going all in, all out. When you're going for a 1 lot, it's great for trade tuning and getting a feel for the market, but it doesn't give you a lot of flexibility with your position. Right? Does everybody follow me so far? Does that make sense? Any questions about that before we keep moving on here? So just putting some of the trade management stuff in a perspective there. No questions? Okay, good. Like I said, every trade is different, but gives you an idea of the kind of things you've got to be looking out for when you're getting into a trade, as well as when you're looking to take some profit targets. So you want to go for some logical targets, low volume areas. You don't have to go all in. And one of the things there is sometimes good to just put something on, something small. And I'll often say that I'm going to put something on because I'm not quite sure, which may sound a little bit odd, but nobody can feel a market better than somebody that's already got a position on. You can develop a better feel for the market when you are already in the market. Something that if you don't already know, you will begin to understand when you do it more often. Okay, does anybody understand that? What I mean by you can feel the market better when you have an open position on. Yeah? So sometimes it's good to put, even if you want to put 20 contracts on, it's sometimes good to just put a one lot on. It's not a lot of risk, but at least you've got something on and you can get a feel for the market. Nobody can feel a market that's going to top out better than somebody that's already short, right? So if you've already got something small on short, you can feel the market even better when it's getting ready to top out, because you are now looking for all of the signs that it's not going to push any higher, and you have a much better chance of feeling that and seeing that if you already have something short. The same if you're getting long. Sometimes it's a good idea to put something on so that you can feel the market. It's a tool. It's a technique for developing a feel for the market. Now, obviously, you've got to be willing to take some risk, but if you're somebody that trades 4 contracts, 1 contract is not a lot of risk. You can put that on. If you're wrong, so what? You know, it's a part of trading. You know, you get out. At least you didn't put a full position on. It's like me. If I'm going to go in with 40 contracts, why should I put 40 contracts on straight away? I might as well put 10 on, then another 10. And the better it feels to me as I'm in the trade, the more I can put on. It makes a hell of a lot of sense. Okay, so from a trade management perspective, I hope you all understand this. I'll be open to some questions. Let's have another 5-minute break and we'll move on. Any questions, feel free to ask. Does anyone trade Euro stocks in here apart from Cam? I'm pretty sure somebody does. No one's replied though. Okay, so right, before I move on though now, guys, I do want to just quickly ask if there's any questions up to this point. So now, I mean, that's pretty much going through to step 5. Okay, now you do need to understand where to take profits on your trades. So I'm going to just move to the charts now and give you some examples of the kind of things you can use for profit taking and establishing targets. Now, one of the things, of course, you can do is look at the bigger picture. This is where you want to get your major targets from. And actually some of your minor targets as well. So bigger picture, something like this. Let's say you're shorting up here. You know, it makes sense to cover at each LVN on the way down because they may lead to rejection of lower prices and a push back up. So low volume areas are great places for targets. However, if you place your limit orders in low volume areas, you might want to place them just above the low volume area if you are short, and you might want to place your limit orders for profit taking as target on longs just below your low volume areas, low volume nodes. So for example, if a short sets up here tomorrow, I'll be looking to short around the 68, 69 area, and I'll be looking to cover around the 66 area, 63s, 60s, 58s. And you basically just take the levels as they come, and you try to scale out as at each one of those levels. So, of course, it depends on how much or position you have on. If you're going all in, all out, and you're just trading a one lot, you pretty much just want to go from one level to the next. You don't want to look for much more. That's from that time frame. You probably on the S&P, a good second target is normally, well, actually what I've just shown you there. First target for me is normally 1 point. Second target is normally 2 points. 8 ticks, to 10 ticks, and sometimes I go for 3 points, but it depends on the volatility and how much the market seems to be moving. Now, from an intraday perspective, let's just say you're shorting up here at these unfair highs. Targets would be this low volume area, this low volume area, this low volume area. So, that'd be first target, second target, third target. And that's how I approach it. If you're getting long, say in this area, what would be your targets? Low volume area right here, low volume area right here. So this is how you use the concepts that were covered yesterday in some detail to take profit and scale out of your trades. Any questions about taking profits and scaling out of trades and picking profit objectives? The other thing you can also do is use high volume nodes. I do sometimes use a high volume node as a profit taking area, especially if we seem to get stuck there for some period of time and start to consolidate, because the market can often get stuck in these areas of acceptance and trade in there for quite some time. So those are also very good profit taking levels. So I do use high volume areas for profit taking. I don't use them for entries. But low volume areas I use for both entries as well as profit taking. Good stuff. Thank you very much, Federico. Okay, good. You guys are getting this very well then. Basically, like I said, just use your levels. The levels are logical levels. Makes sense to use those. Now, let's talk a little bit more about how do you move forward and how do you help put yourself in a place where you stand the greatest chance of success, and in a place where you will gain peak performance. As I said yesterday, trading is very much like playing a sport. It's like being an athlete. You have to be very disciplined, not only in your trading but outside of trading as well. A lot of it comes down to planning and preparation. So it's not only about doing a good job in the moment, it's also about planning very well and preparing really well. So, this is the peak performance loop that some of you may have seen before. But, this is what I believe helps you engage with peak performance. If you have a combination of good planning, good preparation, then perform well with the planning and preparation that you put in place, and then perform and feedback. Make sure you record what you are doing and recognize when things are going well as when they are not going so well. So this is where the trade journaling really comes in handy, and also keeping a chart book and annotating each and every single one of your trades and keeping a record of that. And then again, goes back to planning, preparation, performing, feedback. So every time you feedback, you review your plan. If there's anything to change, what I mean by change is not change your methodology. What I mean is there anything to improve? Should you be trading a different market? Should you be looking at taking more risk, less risk? Should you be managing your trade slightly differently? Okay, but don't go on one trade. One trade doesn't mean anything. It never will to any of you. One trade, unless it becomes a trade that goes very, very bad, but that should never happen if you manage your risk well. You never risk more than 1% per day. So one trade doesn't mean a lot. I've often said one trade and one day is just a dot on the screen. Now, if you look at an equity curve, you'll see it often moves like this, or moves like this for some, or moves up sideways. And each and every single day on here is a dot. That's all it is. So every trade, every day is just a dot that builds this equity curve. Don't look at it. Look at it as being any more than that. As long as you stick to your risk parameters, one trade shouldn't matter too much. It's risks that you fully accepted and you should be willing to take. So if it doesn't work out, accept it, move on. Most of the time, if you can just bring yourself to do that, the next trade works out. That's what I find anyway. I would I would quite happily accept a loss. I get it wrong, I'll get into the next trade. You know, more often than not, it works out. Sometimes the next trade doesn't come that day. Sometimes it comes the next day. That's fine. You take them when they are there. So plan, prepare, perform. That's the peak performance loop. Plan, prepare, perform, and then feedback. So let's talk a little bit about planning and preparation. Firstly, you must have a business plan. Business plan needs to include a vision. Where do you see yourself? What is your major objective? What is your vision? What do you want to achieve? Why are you involved in the trading business? Why do you want to trade? What do you see as a major achievement for your business, for your trading business? What is the vision? Where is it you want to go? What is the mission? Why are you doing this? What is your motivation for trying to achieve this? What are your goals and objectives? Remember, goals are different to objectives. Goals are more abstract. They are like, okay, I want to be a successful trader, but you can't measure that. Okay, objectives are more concrete. They are more well defined. So objectives would be, for example, your goal maybe you want to become a consistently profitable trader, but you know, how would you know that you are a consistently profitable trader? So your objective might be to reach that goal. So your objective would be, for example, if you could see yourself consistently making on average, say, you know, $5,000 a week, then you could say to yourself, okay, that's my goal being reached. So objectives help you meet your goals. So define your objectives and go out there to achieve them. I clearly define my daily objectives, and most days I'll hit them. There will be some days where I don't reach my objective, but most days I do. But that's because I know what I'm after as well. Have a trading plan. Trading plan is a small part of the business plan. Now, most traders think they have a business plan when they have a trading plan. And a trading plan is pretty much how you will trade. It's not a business plan. Trading plan will define, you know, your methodology, how you will trade, and you know, the kind of setups and opportunities you will look for, how you will look to execute your trades, and how you will look to manage your trades. How much risk you will take. What's your risk reward objectives? Self-development plan. How are you looking to grow? What are you going to be investing in? Are you going to be investing in any courses? Some of you guys have already invested. You guys invested in this course, so this is something that should go under self-development in a business plan. Now, you may have a plan to attend some other seminar or buy a DVD or read some books. That goes in your self-development plan. You plan your development as well. Contingency. What do you do if things go wrong? Do you have all of the details that you need? If your PC was to crash, do you have the details for your broker, your risk desk? Do you have them all available? Do you know what you will do if your internet connection goes down and you are in a trade? Have that clearly defined in your plan. Financial planning, detailed financial planning is really, really important. I've covered this in the Getting Started webinar, and as I said, I'll send that link out so you guys can see an example of a financial plan that will be relevant to a trader, taking into consideration expenses, objectives. So you're looking at revenue and expenses. Now, some of the expenses for traders are software, data feeds, trading platforms. So, you know, as with any business, you need to do financial planning. Okay, you need to do a cash flow forecast. You need to have an idea of the money coming in and out of your trading business. I've got a question here from Giles. Do you think having a daily objective can cause too much focus on P&L instead of just performing the process properly? No, not really. I think that if you have nothing to aim for, you're not committed to a vision. So the way that when I define a goal and objective, it's a vision that I have for the day. I envision myself achieving that. Now, and I go out to achieve that. And I trade in the moment where I am right now. So I have a vision, I have an idea of what I want to achieve by the end of the day. I know how I would go about achieving it. And, you end up then trading in the moment between where you are right now and where you want to be. And that actually helps you perform better because you know what you're looking for. It motivates you. So actually, it's a big part of peak performance. So, if you go out there, let's put it the other way. Let's say if you don't have an objective, what's your motivation? Let's just say you go into trading tomorrow and you say, I have no objective, I have no goal, I'm just going to trade. Well, what's the point? What are you trying to achieve? If you don't know what you're trying to achieve, what's the point? Now, you might have an objective to just trade every single trade and then just accept whatever outcome there is at the end of the day. That's okay. That's an objective. It doesn't have to be a financial objective. Your objective might be to just take every single trade. At least you have something to aim for. But, personally for me, I find having goals and objectives and not being too greedy works. Works for me and works for most traders. Now, there's nothing wrong with sitting there and just taking every single opportunity. Personally, I've just found myself, through my own trading experiences, learning that having an objective works well for me. Because I just didn't like the experience. I didn't like the idea of having a very good day and then giving it back right into the close of the day. It just didn't sit well with me. I just don't like achieving that objective. So I think it's, for me personally, it works better to have an objective and then just stop trading. And then I have a risk limit and I stop trading. So it works better for me and it actually helps me perform because I know what I'm going for. I know what I'm aiming for each and every day. I know what I'm out there to achieve. And I will go out there and do whatever it takes and perform the best I can until I get it. So it depends the way you look at it, but that's what I believe. It's only a belief. But I don't personally think that. That's the question. But some others may think that. I don't think that having an objective does make you focus on the P&L. I never focus on the P&L. I don't even look at my P&L when I'm trading unless I feel that I've hit my risk limit or I feel like I've already hit my objective. Don't even look at it. So, very much to the contrary from my belief perspective. I don't think it does. You got to be P&L. You got to be focused. You got to know what you don't want to lose, and you got to know what you want to achieve. That's having an objective, but it doesn't mean you focus on the P&L as it's moving up and down during the day. Okay, so I can see where you're coming from because you're always asking yourself, okay, have I achieved it? Have I achieved it? But that's okay. As long as you don't keep your eye on the P&L and every little tick of the day. The most important thing is that you know what you want. And you go out there and you do the job. You have to. You've put an important point across there, and that's being focused on trading to trade well, and not being focused on just your P&L. So what I mean by that though is not being too caught up in the ebbs and flows of the P&L, but do know when you've lost too much for the day, and do know when you've achieved your objective for the day. That's important. But that period where you haven't reached one or the other, that's when you should just focus on performance. But you should know the limits, the loss limit and the profit limit. What is your objective in terms of the profit? And you should know the limit for the loss. And you got to trade in that gap though. You got to trade and perform within the gap of that focus. Hopefully that makes sense. Okay, so have a daily trading plan. This includes doing your pre-market analysis and also intraday analysis. I show this in the trading room every day. I do my pre-market analysis before the day starts. I highlight what I am looking for and what I am planning to trade around. And I will only trade around that. You guys will see in the room I'm very disciplined. I only stick to my pre-market analysis plan. If for whatever reason I have to develop a new plan, I need to do my analysis again from the top-down approach. So a plan is a daily trading plan. It's not a trading plan that you wrote 2 years ago or 6 months ago and you never looked at it again. A trading plan is a daily thing. you need to develop a trading plan for each and every single day. Mental preparation. I believe fully in the power of full engagement. Now I'll give you another resource that I think you guys should check out. The Power of Full Engagement by Jim Loher. And I forget the name of the other author. But it's not necessarily targeted towards traders, but it's being fully engaged in anything that's performance related, whether it's a sport, whether it's business, whether it's trading. It's about managing your energy and not time, and focusing your energy in the right way towards the task at hand. So here is the link to that. Now, the Power of Full Engagement is very much focused on balancing yourself mentally, but not only mentally, physically, mentally, emotionally, and spiritually. So it's important to stay in tip-top condition. Now, some may argue, you know, physical, what's that got to do with trading? But, you know, at the end of the day, you know, if you're in good health, it's good for your brain, right? If you eat healthy and you exercise, it's good. It raises your awareness levels. It keeps the blood pumping, okay? It's good. But the thing is, your physical health will affect you mentally. So, you know, it's important to not go crazy, that you become a health freak, but do watch yourself, you know, do look after yourself. You know, I'm not in any way a health freak, okay? But I do go to the gym and I try to eat healthy, okay? I don't go over the top, but at the same time, I do look after myself. Now, mental preparation is important as well. You know, be mentally well balanced and emotionally well balanced. Now, a lot of this feeds off each other. So, you know, if you're physically balanced, you generally are mentally balanced. If you're mentally balanced, you're emotionally balanced, and then spiritually balanced as well. Now, I personally find for myself that, you know, spiritual growth has been essential for me, and, you know, I like to meditate, and I like to get in touch with my unconscious, my higher self, and, you know, it helps me with my trading. But, you know, it's not for everyone. But I think, you know, just basically just keeping an eye on physical, mental, emotional, and spiritual health is important. Performance and feedback. Keep your trade ledger. Trade ledger is very much just every trade. You know, each and every single trade you take, your entry, your exit, or your entries and your exits, and then highlighting maybe the time the trade was taken. Now, most people will get this from now, if you trade for a prop firm, you'll get this through them anyway. But well, most prop firms do that, and I know I do, and you probably get it to some extent even on your statements as traders for retail brokers, and you'll also get you know, your, I suppose in some sense, a profit and loss report. But it's important to track this yourself. So you record every trade at the end of the day. Record your thoughts and feelings in a journal at the end of every day. Keep a profit and loss report. Now, some of you guys have seen my profit and loss reports. If you guys need a template, I can send it to you. Just basically a simple spreadsheet where you just record your daily profit and loss. Now, I think trading ledgers and keeping an eye on the detail is more important in the early stages. I think as you grow as a trader, keeping an eye on every single trade becomes less important. So I don't personally detail every single trade as much as I used to in the early phase of my trading career. I'm more interested in just sort of, you know, one day into the next. That's what I'm more interested in, and performance over time. One trade really doesn't mean anything. Even one day doesn't mean a hell of a lot. But patterns from a day-to-day basis, on a week-to-week basis, can, you know, start to mean something. Just see if I can just bring this up. Just give an example. Here's my P&L report for most of my trading for 2011. So just something simple, nothing complicated. just day-to-day stuff. So, of course, you then have a breakdown from month-to-month basis. Just ending P&L. I've taken into consideration commissions, weekly P&L from one week into the next, and then every day for every month. Just a simple record of day-to-day running P&L, and some just basic notes. Not a hell of a lot. That's it. You just need a record of that. Have an equity curve for each month. Have an equity curve for the whole lot, the whole year. So something simple like that. If anybody wants this spreadsheet, it's you got to create. It doesn't automate anything. You have to create it yourself, and you have to add in the figures, and you have to create new sheets every single time. So it's I won't support it, but if anybody wants it, just a sort of a blank template, I'll be happy to send it to you. Okay, so chart book, screenshots of every trade. Now I do this all the time, and I have done for many years. Well, since I started trading, actually. So just some basic annotations of your trades. So here was just an example. I'm not going to give lots of examples, but I share these in the room all the time, and I've marked them up as I'm going along in the day as well, as and when I'm trading. So this is an example of the kind of things you just want to keep a record of. Every single trade you took, the entry prices and the exits. That's all you need to know, nothing more. But I think the charts really help because it's a visual example of the trade you took. You can see what you was looking at. I usually take a picture of the longer time frame chart, what I'm trading around, the context that I'm trading around, and then the shorter time frame chart. Just give me an idea of what happened from a shorter time frame context. Okay. Keep an emotions and psychology journal. I recommend that you guys get an account with Evernote. I think that's what it's called. And if you have an iPhone or something similar, a smartphone, you can actually fill it in by downloading the app. Or something similar. It doesn't have to be that. But I know Evernote is free. And it's really, really good. Just put your thoughts down. Put down what you felt whilst you was trading, when you finished trading. Put down just an overview of if you was emotional, what emotion showed up. Did you trade in any way that was affected by your emotions? Did you snatch out profits due to the fear of a trade turning into a loss? Did you get into a trade too late, waiting for too much confirmation, or did you start trading your stop too aggressively and got taken out of a good trade due to some emotional responses? So just an emotions psychology journal, just recording on a daily basis how you felt when you was trading, and keep a record of that. Now, the L20 Peak Performance Tracking Sheet, which is something that goes out to all of the trading room members. And again, if you want that, it's in the l2stmembers.com website under the important documents section. But basically something that I put together that I use on a regular basis. If I can find it again. Got a template here. And it's just a way of just recording some of the metrics. Where's it gone? Okay. Here we are. So this is something that I mean, you can change these, what you're recording and what you are looking at. But basically, these are some of the metrics that I like to track myself as a trader. When it comes to actual performance and the actual trading, I like to record how patient I was, how disciplined I was, how well I was adapting, was I trading emotionally, what was my entry execution like, and this is from a day-to-day basis, not a trade-to-trade basis. What was my risk management like? Was I maximizing profits? Was I managing my stops well? So I mark this from a daily basis, and it just brings up these graphs, and you can get an idea of what it all looks like in a visual format. And basically what I do is just put in these inputs here. This is an example here. You just put in the date and you just mark yourself out of 100% or out of 10. So you can put in whatever values you like. You can actually change these. These are the things that I like to track: physical condition, energy, how good do I feel, what kind of health am I in, am I sick or am I ill? That's not always a good time to trade. What is my focus and attitude like? What is my belief and confidence like? Fear, anxiety, inner peace. How aware am I of my pre-market analysis, overall state? So these are the conditions that I like to track. A lot of this can be done before you start trading. So the condition, your state, can be tracked before you start trading as well as after, but your performance is tracked after you finish trading. So if anybody wants this, again, just drop me an email. I'll send it out to you. So you guys just let me know what you want out of anything I've shared today. If you want something, just drop me an email. Okay. So that's the peak performance tracking sheet. I use that with my mentorship students, and it helps a hell of a lot. Have a mentor and a coach. Accountability, provides the accountability. Sometimes it's difficult to be accountable to yourself and keep mentoring and coaching yourself. Now, some of us are a lot more self-motivated and disciplined to keep ourselves on the right paths. But, there's a number of ways. A lot of traders like to be in the trading room because that just helps them stay disciplined and see how it's done on a daily basis. Some people like to have a mentor and a coach. And this is where students join the mentorship program or coaching program. Now, I don't take many mentoring coaching students every year, so I do still have a few opportunities this year. But, I don't advertise that, and most people, come to me. Will have to go through a process of me talking to them, figuring out whether it's the right thing for them. But also having trading buddies. That really helps. Each and every single one of you here, it would be good. And there's a few of you guys here from Australia and that side of the world. There's some of you from the States. It's good to have some trading buddies. And that's why I started up the L20members.com website. All trading room members can join that. It's more of a private forum for trading room members only. You go to L20members.com, sign up. You click on this link here, register. As long as I can tell it's you and I know who you are, I will approve your registration. Like I said, it's for L20 members and students only. So I would say be very careful of public forums, trading forums. There's a lot of them out there. Some of them, you get some okay stuff in there, but most of the time these forums are full of traders that are struggling themselves and they're providing advice to others. So it's not a good place to be. A lot of it's just opinions against opinions. A lot of it just, it's just BS. A lot of it's just noise. And so public forums are not a good place to be. But the L20 members forum is good. Like-minded people, trade in the same way. Get in touch with people. Share your ideas. Start new topics, etc. A good place for people to develop trading buddies and join up with someone, and you can help each other grow. Right. Becoming disciplined. some ideas here. Develop daily routines and rituals. So, for example, just have an idea of what you're going to do every day and make it more of a ritual. It's more like a routine. It becomes natural. Now, initially, when you're developing routines, they are difficult when you're trying to break out of bad habits or old habits. Okay, but if you keep doing it, it becomes natural. It's like going to the gym. If you don't go to the gym, you probably don't like going to the gym. But if you go to the gym, you develop a need to go to the gym. It's the same thing when you're developing routines as a trader. If you do your pre-market analysis every day and you do your preparation, you do your meditation, you'd want to do it every day because it becomes a habit for you. It becomes a routine. That's what a ritual is. It's a routine. It's a part of your routine, but it's something that you do day in, day out, or at least consistently, and it becomes a part of your daily routine. So I have my routines, I have my rituals. My days are pre-planned, and I try to stick to the same schedule pretty much every day. Raise awareness of reoccurring bad habits. May sound simple, but do raise awareness of what you see yourself doing time and time again, which you can clearly recognize as not a great thing to be doing. So, for example, snatching up profits, or not doing a pre-market analysis, going into the market and just looking to trade with no real plan. That's never a good idea. Doesn't matter how well you think you understand things. You should take some time to understand the market before it opens up and develop a plan for each and every single day. Consciously create good habits. So recognize by raising your awareness when you are performing bad habits. Start to recognize when things are being done that shouldn't be done. Now, a lot of the time it can be difficult to change bad habits that are unconscious habits through conscious effort. And this is when you start to do more mind work, and you might start using some of the other techniques that I'm going to share. So also unconsciously create good habits through the use of visualization. Very powerful technique. Most of us know it and we understand the power of it and the strength of it, but most of us don't do it. And it's important that you do it. Visualization is very, very powerful, and if you do one thing more than anything else, make sure you visualize your day ahead and visualize yourself achieving your objectives and being where you should be at the end of the day. So, this is like, for me, we had the question earlier on, is it a good thing to have an objective? Well, for me it is, because I actually see myself achieving that objective before I achieve it. You have to see it first. You have to see it on your mind's eye. Power of attraction, whatever you want to call it, the law of attraction. It works, but you have to practice it. It doesn't mean you just because you see yourself achieving your objective every day, you're going to get it. But it definitely beats not seeing yourself achieving your objective and beating yourself up, right? It's definitely a better place to be, and you have a much better chance. If you stay in a positive state, you have a much better chance of performing well. And one of the best ways to get fully engaged and perform the best you can in the moment is to stay confident. Believe in your ability to achieve your objective. Know what your objective is. Know what you are going out there to achieve each and every day. So this is an example of my daily routine. I get up at 6 a.m, I meditate, and then I have breakfast. I do my pre-market analysis at 7 a.m. I'm normally done by about 7:15, 20 past 7 a.m. Then I'm ready to trade the European markets. I generally trade most days from 7:30 a.m. to around 11:30 a.m. There will be some days where I still have a trade open coming into the lunch period, but it's very rare. Most days I'm done by 9:30 a.m, 10 a.m. on the European session. Very rarely do I trade past that, but there are days where I do end up having positions that I'm still holding and waiting for my targets. I can't make the market move, so I sit there and wait until it happens. If I could finish trading on time, I normally squeeze in a gym session at that point in time, 11:45 a.m. up until 12:45 p.m. And then I have lunch. Doesn't take long, about 1 p.m. to 25 past. Then I'm opening the trading room at 1:30. Wait 15 minutes for everybody to log in. We start the trading room at 1:45 p.m. I go through the pre-market analysis for the US session. I discuss what's already happened on the European session. I develop my trading plan during that 45-minute session for the day. And then at 2:30 p.m, the US cash market opens up. I start trading and trade the US morning session. And my plan is to finish at 4:30 p.m. There are odd occasions, and it's happened a little bit more so over the last 2 months, but it's only been probably 2 or 3 days where it's had to happen, or it's happened, where I've ended up holding a position past that time. So most days I will finish at that time, but I can't, as I said, predetermine how long it's going to take for a trade to finish. It's push, and if I'm in a trade and it's open and I have no risk on the table, or very little risk on the table, and I have no reason to get out, then I have to just hold it. Then I would normally sit to meditate for another half an hour during that lunch period for the US session. Then I do administration work, I do my emails, etc., send some replies to emails, give myself an hour between 5:30 to 6:30 to do that. Then 6:30 to 9 p.m. is really my family time. So ideally that's why I don't want to trade the US markets during that time, and that's why I don't want the trading room during that time. But sometimes I do get stuck in a position, but even during that time I will leave those positions on, and most of the time I'll be spending time with the family. I like to cook. I developed a passion for that, so I like to cook and then have dinner. Then my routine is to watch the close of the US markets, have a look at how they close, and then I watch to see how they reopen as well at 9:30 p.m. GMT. And then 9:30 till 10:15 I do some mind work, I use some NLP techniques, timeline therapy, do some more meditation, and some of the other things that I'm going to share with you in a minute. And then finally that's it, family time, and then up until the point where I feel sleepy and I go to sleep. Then next day, same stuff. And that's pretty much my Monday to Friday routine every day. But it's well planned, it's well defined, and that's pretty much my rituals and what I stick to. Now, some tools for peak performance. Just give me about 30 seconds here, guys. Right, sorry about that, guys. Okay, so okay, got a question here from James. Taking up transcendental, transcendental meditation. A lot of my students actually have taken up that style of meditation. Now, there's lots of different styles of meditation, and they all have different labels, but most of them are after the same goal. Meditation is very much about achieving a raised awareness and letting go of your attachments, the physical self, and therefore letting go of a lot of emotional attachments to problems as well and issues. So meditation, obviously that's in a nutshell, but transcendental meditation is one of the forms of meditation, and there's lots of different ways to meditate. So yeah, I mean, absolutely, try out what you feel is necessary. I practice myself transcendental meditation. It's pretty much what I do. It's actually exactly the same as any other meditation, in my view, and it's after the same goal. And the main thing, I use meditation to achieve one major goal: to get in touch with my higher self. That's my main goal, and lose the attention and on the more physical level within the mind, and quieten the mind, become more peaceful, gain an inner peace. So if you have a lot of mind chatter, or you recognize that when you're trading, the inner voice is just going crazy, then meditation is a great thing. Meditation allows for you to become aware, firstly, of that inner voice, but it also allows for you to quieten that down and gain that inner peace. You become a lot more silent within, and that's where you get that inner peace. When your mind is not going crazy and you're not having lots of thoughts, you gain peace. So meditation is really, for me, it's about becoming thoughtless. It's about being embraced in the presence, just being present in the moment, in the now, and just letting go, letting it go and letting it flow. So it's a great way to just let go and just rebalancing yourself. Just rebalance yourself and gain raised awareness. So I meditate at least as a minimum 2 times a day. And I like to put in the meditation during the lunch break as well. Even if it's just 10-15 minutes. Now, I sit there and meditate for anything from 20 minutes to half an hour. Okay, sometimes even 1 hour. Now, you don't have to do it for that long. Okay, I think the best thing to do with meditation is start with something like the technologies that I'm going to share here, and just do 10 minutes a day. It's better than nothing. Okay, again, meditation is not for everyone, but I do it, and I think it's a great. I think it's a great habit. It's a great thing to start practicing if you want to become a better trader, because it gains inner peace and awareness, and that's a great tool to have as a trader. And it helps you in life, not just in trading. So, tools for peak performance here. Excellent business planning. We talked a little bit about business planning earlier and some of the things that you need to define in your business plan. Have outstanding daily preparation as well as a daily trading plan. Know what you will do in the day and know what you are looking for. Healthy diet and exercise. Now, don't have to go over the top, but, at least keep yourself in good physical condition. Not necessarily meaning, you have to become, a bodybuilder or anything, but just look after yourself a little bit. Sufficient sleep. Very simple stuff. I've got some typos there, but please ignore those. Sufficient sleep. Make sure you sleep. Sleep well. It's been proven that, lack of sleep does lead to lack of attention and focus. A lot of studies have been done to show that. So just make sure you get sufficient sleep. Now, sufficient sleep for you may be different to me. Okay, but as long as I get 6 hours, I'm okay. Okay, in most cases. Some days you'll be a little bit more tired than most, but some other days. But if you have a long day, you might need more. But you do need to get sufficient sleep, especially if you want to remain focused and fully engaged in your trading, and you look at the trade at a level of peak performance. I am statements and affirmations in alpha and theta. Now, alpha and theta are different brainwave states. I'll just cover that very briefly. Let me just share something. So, brainwave, these are the brainwaves that we experience as human beings. And each brainwave has a frequency. Now, we spend most of our time in beta, which is 14 to 21 cycles per second. It's the waking state where we are more engaged with the 5 senses: hearing, seeing, feeling, tasting, and smelling. Okay, perception of normal time and space. Now, often if you read books or you listen to high peak performance athletes talk about being in the zone, a lot of them will say time slows down, and they have this sense of being right in the moment, in the now. But a common occurrence is time slows down. Okay, and this is normally an occurrence when you get into alpha state, then dropping into theta. So being in the zone requires you dropping from beta to alpha or theta. Now, there are brainwave technologies which I use on a daily basis, and I totally believe in because I know they work, because I've felt the benefits and I've had the experiences of it that work. So I can highly recommend this. I can vouch for it because I personally use this stuff. So getting into alpha and theta really helps. Dropping the brainwave frequency. If you drop the brainwave frequency, you generally have less mind chatter. And when you have less mind chatter, you can be more aware of the present moment. You can be more in touch with your feelings. And this is where you develop a greater intuition. And as I talked about earlier on, in trading, intuition is a good thing. It's an important thing to develop. And most traders develop that when they drop into alpha. Okay, their brainwave frequency drops. Then we have theta, which is deeper sleep and meditation. That's when you experience that through meditation. So when you meditate, and you meditate on a regular basis, you get your brain used to being at lower brainwave frequencies. Therefore, you have less mind chatter, and you have a greater chance of developing a better intuition, better better sense of being in touch with your emotions and your feelings. And then we have delta, which is deep sleep, your unconscious state. Okay, but through meditation, what you're trying to achieve is alpha and theta states. Okay, so one of the things that I like to do is I use I am statements. And I am statements are nothing more than affirmations. But some people say affirmations don't work, but affirmations do work, but they work better if you are in alpha and theta state already, if your brain waves have dropped down in frequency. And you can do this by using some of the brainwave technology that I've discussed here, or highlighted here, Neuroprogrammer 3 from transparentcorp.com, and also Centerpoint's HoloSync from centerpoint.com. Now, I use those personally, that's why I can vouch for them. There's probably more out there as well. Actually, there's NeuroVector as well, which I have used, but I tend to use Neuroprogrammer 3 and HoloSync more than anything else. The technologies that you will find these pieces of software using, yeah, they do have a trial, so do try it out. But with anything, as with anything, don't just try it once and expect magic to happen. You have to do this stuff on a regular basis. If you're going to meditate, don't meditate for one day and expect, miracles. Meditate every day for about 3 months and see what happens. See if you feel the benefits of it. I have never known anybody to meditate and not feel the benefits of it. Okay, not anybody that's actually meditated for long enough, anyway. And it's the same with using the brainwave technology, Neuroprogrammer 3, HoloSync. You have to do it. You have to use it every day. You have to say, okay, I'm going to do this time every day for the next 3 months. It doesn't take long, 10-15 minute sessions. I mean, each and every single one of us have to be disciplined enough to take 10-15 minutes out of our life to help improve our chances of becoming successful. It just makes sense. If you're not disciplined enough to take the time out to do this stuff and develop routines and become disciplined enough to stick to daily routines, you're not going to be disciplined in your trading. So you got to remember that being disciplined is a way of being. It's not just being disciplined in trading. You have to be disciplined. Being disciplined is a way of life. You have to be disciplined in general. It's your natural state of being. You are a disciplined person. And being a disciplined person leads to you having a greater chance of being disciplined in your trading. Okay, so work on your discipline, not only in trading but outside of trading. Develop some routines, develop some good habits. Start doing some of this stuff. So I am statements is pretty much just make a list. Sit there and say, just open up Microsoft Word and sit there and say, okay, what is it that I want to be? Okay, so you just sit there and say, okay, I am, what is it you want to achieve? But don't say to yourself, okay, I will be, I will become. Say to yourself in the present moment, as if you have already achieved it. Okay, so these are more so like affirmation to yourself. It's almost like unconscious conditioning. You're conditioning yourself to believe these concepts. So, beliefs are nothing more than I am statements reinforced. And if you understand how the brain works, which I covered in the NLP webinars, our belief systems affect our behaviors in a massive way. And if we can reinforce new beliefs by using I am statements, it really helps on an unconscious level. Okay, keep reinforcing. I am a great trader, rather than hearing yourself, because you are always affirming things to yourself. Okay, if any of you guys have ever heard yourself talking to yourself with that inner voice, I mean, how many of you have ever experienced an inner voice? Okay, an inner voice. Okay, something within you talking to you. There is an inner voice, right? Most of us have an inner voice. We talk to ourselves in our heads, day in, day out, whilst we're in our waking state, whilst we're asleep. So, if you can control what you are feeding yourself, you may as well feed yourself some statements that are in line with your goals and objectives. So I am great. I am trading well, etc. You know, some simple stuff. I am a millionaire. I am confident. Whatever. Put it on there. It's your choice. Nobody is stopping you from being any way you like to be in the moment, apart from yourself. So you say to yourself, I am this, I am this. And it's a very simple concept. You write it down. Now, what I personally do is I then go into my piece of software, Neuroprogrammer 3, and then I record myself saying these statements to myself, and then put a piece of audio in the background which is designed to put me into alpha or theta state, and that makes the auto suggestions even more powerful. So if I'm constantly hearing myself, saying to myself, I am confident, I believe in myself, I believe that I am a great trader, I trade well, I trade in line with my plan, I am disciplined. You constantly keep hearing yourself saying that to yourself. At some point, you develop an unconscious belief. And that unconscious belief starts to play itself off. You start to experience it. It's automatic. You don't have to do anything. You just have to feed yourself the suggestions. You have to begin to believe it on an unconscious level. That's the power of the unconscious mind. You tell it stuff, it will believe it. Now, you either have a choice to feed it negativity or positivity. But you can make the choice in the moment to feed it positive stuff that is in line with your goals and objectives. So these are the tools that I use. You don't necessarily have to believe in them. I'm just showing what I use, and I know it works. NLP and timeline therapy. That's what NLP stands for. NLP stands for neuro-linguistic programming. TLT stands for timeline therapy. That's unconscious reprogramming techniques. Now, I am a certified master NLP practitioner, and I have been since 2005. And I use NLP in my own trading. I have done many a times, and I use some of the NLP techniques. I've even done webinars in NLP. There was actually a NLP for Traders event on our website, and that might be useful for some of you if you're interested in learning more about NLP and some specific techniques, practical techniques that you can use. There was actually an NLP meditation included in that seminar, that webinar. Brainwave technology, I've just shown you Neuroprogrammer 3 from transparentcorp.com. There's lots of different programs in there actually, and you can take your pick which ones you want to use. Now, again, I don't want to make this overcomplicated. There's lots of stuff you can go out there and find. Now, I've been on a huge journey to find stuff that works for me, and I'm just sharing with you with what works for me. So, you know, you can go here, build affirmations, scripts, you can type them in, you can say them, you can record your own voice, you can open up new sessions, you can deal with any of these issues, anxiety, athletic performance, develop better cognition, attention, become more energized, motivated through these pre-programmed set up sessions, all using brainwave technology. But you know, you got to do them to feel the benefits. Okay, so that's another thing you can do. Centerpoint's website is good. I mean, they've got a HoloSync solution, which is very much just using binaural beats to develop different states using brainwave technology. So mostly HoloSync focuses on alpha, theta, and then delta states. Again, it's just similar, but you don't need both. I happen to have both, and I actually have others as well. But these are the two that I recommend and I personally use. And then books. I discussed this earlier on. Ari Kiev, Psychology of Risk, Mastering Market Uncertainty, and Trading to Win. I don't really think you need much more. Now that might seem like a big list to some of you, but for me it's actually a small list if I consider everything that I've been through over the years. And this is pretty much what I can say is most important to consider to develop peak performance, to put yourself in a state of being where you stand a greater chance of trading well and being less emotional when you're trading. So these are tools. These are techniques that you can use. Very simple stuff, nothing overly complicated. Stuff that you can go away, pick up and start using straight away. Okay, so that's pretty much it. That brings me to the end of the presentation. Pretty much right on time. Gone at 10 minutes past 9 GMT. Any questions? So now let's open up for questions and I'll be happy to give you some answers. I hope you guys enjoyed the last 2 days. There's been lots to take in. And I've made everything that I know and understand as simple and easy to understand as I possibly can. And I hope it all made sense and you can at least take away more than one thing, at least take away the information and put it to use. So, you know, my objective was to give you practical information, but share it to you in a way that you can understand why it works and how it works, so you can go away and apply it creatively and not be limited in any way to the use of the tools. So, you know, I hope I've achieved my objective and you guys enjoyed the seminar over the last 2 days. So any questions, feel free to ask. Right, excellent. Thank you very much, Giles. Thank you very much, Federico. Hope the rest of you guys also enjoyed it as well. So, like I said, it's the end of the presentation, beginning of your journey. Lots to take on board. You guys will all get the recording, so you can review. Now, this is a really important concept as well. It's really important to understand that you have to review this stuff. Sometimes things won't make much sense right there and then, but with some experience you go back to it, it makes a lot more sense. Now I do this with books, I do this even with my own material. I go back and watch my own webinars and seminars, believe it or not. But you know, we've all found this with books. We read a book, doesn't make a lot of sense, we go back, had some experience, and it all makes a lot more sense. Great, excellent stuff, guys. Well, I gave you I put my heart and soul into this. It's about the best I can give in 2 days. It's not a huge amount of time, but it's enough to give you what I wanted to give you guys. Good stuff. Yeah, for some of you guys, it's going to be reinforcements, but I'm sure you guys that have been on the previous seminars have also picked up some new stuff and some new insights. And that's, you know, always important to continue to grow and continue to evolve and continue to move forward on your journey. Like I say, success is a journey, not a destination. So stay on that journey and keep moving forward. Any questions, please feel free to drop me an email. I will send the recordings out once they are ready. I've got a few things to send out to you guys. If there is anything in particular that you guys need that I've shared over the last 2 days, please feel free to drop me an email. Email address, I'm sure you guys are aware what it is. It's kam@l2s.co.uk, or you can drop an email to info@l2s.co.uk. The recording, well, the recording from Instant Presenter will actually, I can send that out sooner, but I've also made recordings using another piece of software, and that might take a little bit longer. So, but yeah, I'll start sending these out. Should be able to get the Instant Presenter recording to you guys tomorrow. Should take a little while to process, but yeah, it'll be ready. Either way, you'll have a recording by tomorrow, and then I will complete the other recordings as well. And some of you guys, I know, have had some issues with the Instant Presenter recordings in the past. I'm hoping they are better now because they have changed the plugin, and I've watched them back and they seem to be okay. But for that reason, I've also recorded the webinar, the seminar, in a different format with Camtasia Studio. And I will review those recordings and process those recordings and send them out to you within the next 2 or 3 days. Shouldn't take too long. But either way, you will get a recording very soon. You will get the recording from Instant Presenter by tomorrow. Let's put it that way. Okay, guys. Well, thanks for joining in. It's been a pleasure as always. Great to have you all on board, and I look forward to keep working with you guys. So, see this as the beginning of the journey. I'll be happy to support each and every single one of you if you have any more questions. And take care, guys. Have a great day, great evening, a great morning for some of you. And take care.